Hit it.
It's Friday, April 5th, 2024, episode 236. I'm Patrick Ceresna.
Patrick, where's the pep? And I'm Kevin Muir. This week, we have the great pleasure of welcoming to the show Paulo Macro. Paulo has long been a celebrity on FinTwit, and with his recent move to Substack, is now writing his own financial newsletter. We talk about why this cycle is different, which commodities have fundamentals improving under the covers, and how he is playing this new era. Then we have a special doubleheader with our good friend Kuppy coming on to the show to announce a new stock that he had previously never mentioned. Make sure you stay tuned to find out how Kuppy is playing the gold rally. Then Patrick tells us what the hell is happening with his crayon drawings in talking charts.
And we end with crayons with Kevin. Folks, we might even drink some beers along the way. So Danny, hop on. What beers are we drinking today?
Well, you're drinking the Wonder Beyond Imperial Great Rift Milk Stout. This is an English milk stout. Flavors of milk, chocolate, dark malts, and subtle berries, brewed with mountains of lactose. Generous additions. I don't know what that means, but generous additions of oats and extensive range of dark malts. Sounds like it's good.
Oh. It's 13.5%. This is like drinking wine
with milk.
Oh my God. This might not.
I'm really upset I missed this one.
What are you drinking there, Danny?
Oh well, this is a 9 a.m. road stop, but it is a Donna Quas Amber Especial, a classic Vienna style lager with a full body and smooth finish.
Oh, there you go.
This is a roadside beer.
There you go, Kev. Let's get some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the bearish delusion disorder, the short squeeze scurvy, and the inverted optimism syndrome.
Yeah.
Can't even get that one out.
Well, I suffer from all of those. All right, let's get the guest on.
All right, it's our great pleasure to welcome to the show Paulo Macro. And I just want to say a big thank you because Paulo has been one of those guys that's been on Twitter forever. And he always said that when he eventually goes on a podcast, he's going to come on to the Market Huddle first. And true to his word, here he is. Paulo, thanks for doing this.
Man, I'm really nervous, excited. I don't know what the ratio between nervous and excitement is right now, but I've got my glass of lore here because it's Friday afternoon after the close. It's been a good week for the home team.
Oh yeah, for sure. You guys have nailed it. Now we'll talk about that, but let's learn a little bit more about you. And just for those who don't know, you actually have a Substack. It's called Paulo Macro Substack, and you've been writing for, I guess, how long you've been doing the Substack?
Actually, just since the beginning of the year, and
it's relatively new, right? And
yeah,
so
very new.
And you've been on Twitter for a long, long time, though.
Yes, sort of inactive for the first few years, but like so many of us in the kind of financial Twitter sphere, you're locked at home during COVID for months on end, and sort of out of boredom and isolation, you end up sort of spending more time looking around and realized there was a whole community of people talking about macro on Twitter of all places, and it sort of grew organically from basically nothing. I'm still shocked that I have a following, to be honest with you. And I don't say that because I want to sound modest about it. Like, I truly don't know what is wrong with 130 plus thousand people that they care about, like a Cloudberry avatar.
I completely disagree. You write some great stuff, and one of the things that when you wrote, I used to see these tweets and I'd be like, oh geez, this guy really puts his thoughts together in a great way with all the threads. And then we got to know each other a little bit, and we were on WhatsApp, and you left this voicemail, and the voicemail was like 6 to 10 minutes of you explaining something. I was like, oh my God, not only can he write, he can actually speak and express himself. So it was like, I knew that you were going to be awesome at this. So before we start talking about the market, so let's learn a little bit more about you. Where are you from? Give us a little bit of your background. Did you always think you were going to become the Paulo Macro, the trader extraordinaire?
No, well, I'm a rare breed of New Yorker who's actually from here. I'm a born and raised New Yorker. Background is Brazilian, so I've kind of worked, the whole we're speaking Portuguese here in America without even realizing it yet. The sort of EMification of developed markets and everything that I'm sure we'll get into later. but kind of a foot in both worlds with family from Brazil and growing up sort of bilingual with both passports and kind of being back and forth between both places. I always grew up here, though. I never lived in Brazil or went to school there, but always sort of felt like I had a foot in both worlds. And as I sort of grew up, I kind of fell into it more because, I, without dating myself too closely, I've been in the business in finance for a bit over 20 years. Combination of both an analyst and sales or marketing on both the sell side and the buy side. I've done the analyst work on both sides of the street and the sales and marketing role on both sides of the street. And so I'm a bit of a misfit toy in the business, having come into the world of finance in, right around the top in the .com boom where, the money seemed so easy and everything was growing to the sky. I was sort of, my early experiences were sort of forged in the crucible of the bear market as the tide went out on .com and TMT.
Okay, but let's back up because I know a little bit of your background and you're missing a great part of it that I think you're shrugging off. You didn't go to school like with an economics degree, or you didn't go to school to get a finance degree. You went for something completely different. What was it?
Yeah. So my music ran through my house growing up from a very early age. And my mom, who is still a piano teacher, classical, and she was also a singer, she always insisted that my sisters and I grow up playing an instrument at an early age. So we grew up playing the violin, classical violin. And for a while there was playing kind of, quasi-professionally as, a kid and an adolescent. And when I went to college, I was actually a music major and I graduated with a BA in music. So I've kind of hinted at sort of the balanced brain or the right brain. But, in a way, having the musical background gave me a little bit of facility with math since, the math and music kind of go together for a lot of people.
Okay. But actually explain that, because I think the people that aren't in music might not understand that.
Not much to say other than I just,
but like the math and music, like how do they go together?
For me, it's music is just another language. And I guess growing up bilingual with Portuguese and then learning music from a very early age and getting that in your head, everything from the basics, just scales, what have you. And, refining your ear, making it more sensitive. You try to do this stuff as an adult and everything seems so much harder, right? To get the first 10,000 hours of any kind of discipline. And so the earlier you can start learning any language, the more sensitive your hearing and your understanding of that language over time will be, and the advantages that come with it. And I think there's something to be said for mathematics as sort of like the universal language or the language of the universe that we would all communicate in if we, all beings met in one spot somewhere. Right. So on some level there, I think that's where kind of the magic happens of sort of multidisciplinary approaches. And, being someone, for example, who fell into finance can identify trends or parallels. We talk a lot about, history rhymes. It doesn't repeat, nothing changes over the centuries. People still behave the same way. But then also being a good communicator, I spent much of my career in sales, sell side, and then also marketing hedge funds on the buy side. Just makes you much more attuned to, as much as I am a type A person, trying to be a better listener and a more effective, salesperson who's covering, a PM or an analyst, but also the understanding of language and math. It's, math is basic, is basic stuff that you kind of need to have in pocket if you're going to work in finance in any kind of capacity. Right. So just generally being a good communicator.
Okay. So now
also,
sorry, go ahead.
I find that if there's an edge out there, and I hate that word. I know anybody who kind of deals with money, whether they're running a fund or what have you, is always asked what your edge is. I'm nothing special in terms of having an edge because I think the ultimate edge is being a good risk manager. And I'm probably one of the poor people in that regard. But if I do have an edge, it's in actually discerning narratives. And this notion that some people say I have a bit of a talent or an advantage in being able to look around corners and seeing where trends are going to go next. And it's more just being sensitive to the fact that in communicating with people, I can tell where a narrative might turn next. And I credit all of that to my early knowledge of language, including music, and math kind of came along for the ride with that.
That's wild. So what instrument did you play?
Violin.
So it was violin the whole way. And do you do the viola? Do you do the cello? Or no, you're just like, you stick to the violin?
Yeah, I actually picked up the viola later in high school, and it's something that a lot of violinists do to make more money, because there's always a shortage of people to play viola, and you still need them.
See, look,
so
you're doing the arb early.
Exactly, you're doing the arbitrage early, and so for me it was. But I also ended up kind of in adolescence, becoming tall and bigger, and watching me play the violin is sort of like watching Shaquille O'Neal play a ukulele. It's a little awkward, So the viola is a bigger instrument. If you're a bigger dimension guy, you can kind of get your arms around it better and put your back into it and get a bigger sound. So I play both. Yeah.
All right. Are you going to share with us what school, or are you going to keep that a secret?
One of the Ivies. I'd hate to share it even if I wasn't anonymous. But they took me for the music. I got into this racket because I thought, hey, there's easy money all over Wall Street. It's 1999. Let's go.
Right. It was just funny because the way I learned about this one time was, I won't say who it was, but we were chatting, Paulo and I, and he says, "Oh, I went to school with that guy." And I was like, "Wait, what?" And I don't know why, but you always just seemed like street smart guy. You seemed like somebody that went to, like the state school. Not that I'm saying anything bad about it. And then I find out he goes to this fancy school. I go, "Whoa, this is kind of different." And he goes, "Oh no, but I went for music." And I was like, "Oh geez, now this is a story I need to know." So it's fascinating, and it just kind of goes to show you how much different you are. So you come out of this with your degree in music. How do you fall into Wall Street?
Man, this is, without getting into too long of a story, I actually started my career in the sell side in a global investment strategy group at a major bulge bracket that people know. It's a household name. Very good reputation for strategy and macro. And I went because a buddy of mine, this was the summer between second and third year in college. So it's the year before you're supposed to do your junior analyst, summer 10-week program, whatever. And I'm still into music. I've got the BA music track going, but I figured, let me go make a little money. And a buddy of mine calls me, says, "Paulo, you got to get back to New York. I got the ultimate job. Just, it's walk in and walk out. Like, you'll nail it. No problem." He says, "I'm a temp. Go into this company called Randstad. It's like the second largest temp agency in the world, a Dutch company with an office in Midtown. Take the the typing test," because this is all like email was just kind of becoming a thing,
right?
So you still have to interview with somebody, type X number of words per minute, what have you, and then ask them to farm you out to this bulge bracket downtown. They have a sub office, a satellite office for Randstad in the building, and then you just float like week to week. Like every Monday morning you come in, you get a card, and when the job's up, you go on to the next group. And
wow.
It was actually
was this?
So this was summer of 2000.
Okay, great.
And of all things, like, it occurred to me only after the fact how smart this seemed, because it's summer, and if you're a temp, that's when all of the secretaries and assistants are taking vacation, getting married, doing their honeymoons and what have you. So the demand is through the roof for that kind of seasonal work. You're getting paid. You're not getting taken advantage of like an internship for $2 an hour or whatever. Like, you're getting $20 plus time and a half. And, of any other place in New York, you're working overtime on Wall Street, right? So even just stretching an extra 10 hours a week, now you're doing the 40 hours times 20 is $800, but you're working, call it 9 to 6. Now you've got another, or 9 to 7, 8 to 6, you've got another 10 hours at 30. You're walking away with $1,100 a week to sit there and just, read a book and answer the phone a couple of times a day, and nothing is going on. And all the people who have assistants are MD and up. So you're actually shadowing the real hitters, as opposed to being placed on some trading floor next to some poor 24-year-old first-year associate who just wants to get rid of you and is like busier than he can ever imagine. You're actually getting FaceTime with real people in the firm who have been there for years. So my first assignment was actually with the global investment strategist who had just joined New York. He was the chief European strategist for the firm. And I was a bit of a neat freak, living at home. Poor guy, like they had literally boxed his life up, moved him to New York. He was hitting the road, getting FaceTime with clients, like, who is this guy, what have you. He hadn't even had a chance to unpack. And he was a real, like, forgetful professor, like, sweet British guy.
Yeah.
And it drove me crazy that there were like 40 boxes in his office and he had barely opened anything. So I opened a box while he was out one day. And I asked him just to like sit with me for 20 minutes, show me what's important. I remember, like, this is before research was being emailed. So he's got boxes full of like printed research that used to go out by mail. He like used to write notes on napkins and stuff. He was really disorganized. And after doing a box with him, I'm like, okay, there's a yes pile, a no pile, and a maybe pile. No problem. So he goes on a trip. And a few days later, I've gone through every box in his office. And this is like a corner office with the mahogany. It's like a law firm in there, right? But it's a mess. And I felt bad for the guy. He'd been in town already a few weeks and he was swimming in boxes. So I organized everything, man. Like I put the printed research in binders, like the big 3-ring binders where you like print the labels on the side. I dusted and cleaned everything. Like I moved this guy and he comes back from the trip and there's a pile about 2 feet high of like maybe stuff that I just wasn't sure about whether to throw out. I'd taken like 4 trips with huge black heavy duty garbage bags in the service elevator of this place. Like the guys in the back knew me as like a dude taking out the trash. And I'm 19 years old. He was literally floored. We sit down for an hour. We go through the maybe pile. I finish up the project. And mind you, he never asked me to do any of this. I just did it because I couldn't stand to see it. Right. And there was zero expectation of this. Like you're an assistant filling in. That weekend, the phone rang and my mom answers and she says, yeah, no, he lives here. He's my son. I'm looking at her. She hangs up. She goes, do you know this guy XYZ? And I'm like, yeah, I'm temping for him. She goes, that was his wife. She was calling to thank me. and I was like, okay, that's embarrassing. She's like, what did you do? And I said, I like moved him in, cleaned his office. And she goes, she was asking for permission if it's okay to invite you to their house in Greenwich, Connecticut for dinner.
Oh, wow.
Yeah. So, you hear these stories about guys in the 80s, Solomon Brothers, who were like in the mailroom and got their like, shot at the floor. Like I got my shot because I cleaned the guy's office. And from there, I never had to interview for a job in college because he said, when it's time to do your summer analyst work in junior year, just call me, do it here.
Oh, that's awesome.
9/11 happened. We were, across the street and, like they moved all these people like to folding chairs at like private wealth management offices in Long Island and stuff. So they were sending me work at college senior year and just paying me as like an independent consultant. And he was a very kind man. Like, he gave me my first kind of taste of macro. That was a very long story, but I tell people like, if you can impress somebody by truly just doing something nice for them when you're starting out, and certainly if it's a job that like, they'll never get to, or they don't want to, deal with something, like people remember. And he was very nice to me because he gave me, not a lot of people on Wall Street would just keep something open-ended and say, hey, if you want a job here, just call me. Like it's done,
I always tell my kids that when they go to jobs, and I say, whatever you do, just find a way to make yourself useful. Just look around, figure out what needs to be done and do it.
Totally.
Yeah. I also heard someone else, I'm sorry to interrupt. I also heard someone else say, find the job your boss dislikes the most and do it for them.
Yeah.
I was like, well, that's actually not a bad idea.
And if you can take that and then also marry it with, like if you're on the buy side, for example, or you're covering on the sell side for something, like take the assignment that nobody's wanted to cover for years. This is how I started in commodity equities, actually, a couple of years later. Was I got assigned, from there I decided to take a break, right? Graduated in the early 2000s, 2-year bear market. And I realized I didn't want to, I didn't really like the pace of sell side strategy. It's cubicle analyst work. You're living in data stream and Excel and what have you. And I thought I was going to Wall Street for the action. I wanted to see the trading floor. Right. Like, do they still use hand signals? And mind you, like, so we were down by the trade and the guys from the NYMEX would come out and have their smoke breaks, like in the jackets. And you think it's the best. So like, I wanted a proper experience that didn't involve just living in a cubicle and you're early 20s, what have you. But I ended up taking a year off because obviously you're interviewing for jobs like in the aftermath of 9/11, like nobody's hiring, everybody's going to funerals. It was just a rough time.
Yeah.
And so I took a year off. I was ski bum for a year with my college roommate. We actually drove out to Vail.
Did you live there?
Vail. Yeah, I lived there for 8 months, and I worked a $10 an hour job wearing an apron and tuning skis in the back shop in West Vail.
And did you get the trouble about some of those jobs is you don't get as much time to ski as you might guess. Did you get enough time to ski?
It was awesome. The guy who owned the shop was my roommate's cousin and my college roommate. So we went out together. And the way he would set up the shift is the shop was open 8 to 8. It was a rental shop, like, ski shop right at the base of the gondola there in West Vail. And we worked the rental counter and the back shop. And the shop is open 8 to 8. So everybody works 6 days a week, but it's 8 to 1 or 1 to 8. And the mountain is open 8:30 to 4. So if you work 8 to 1, guys come in off the hill, you're up on the mountain from 1 to 4. If you're, working the afternoon, you ski all morning and you just come down at lunch and take, relieve the guys who want to go skiing in the afternoon. So you could ski every day if you wanted to. And I actually, one of the perks, because nobody makes any money in these places, like you're living hand to mouth, right? Like especially with the pricing for the tourists, like you can't afford a $15 burger on $10 an hour. It's crazy. So you develop actually a really interesting, like barter system with other locals.
Okay.
So the bar next door, Garfinkel's, which I think is still there, they had a little menu like on a business card that was laminated, and on the back it was like the locals menu. And so like any beer was $1, burgers were $2, fries were $1. Like, so you had like the alt menu, and it was all subsidized by the tourists.
Oh, that's great.
And if those guys like, needed like a free wax or like, we would wax their stuff like every day. They'd come in, like we just throw wax on it. If we needed to like grind some equipment for them, throw it through the grinder. Like the alternative economy between like the poor locals and the tourists, you could drive a truck through the pricing. It was quite something.
That's pretty funny. So now over the years, you must have skied a lot of places. Is Vail still in like number one in your heart?
Yeah, I kind of, after living in Vail, I skied over 100 days that year because they had the e-passes. Like the shop, one of the perks was they gave you a season pass.
Okay.
And you can ask the guy who scans you when you get on the mountain, like, how many days have I skied? So I got over 100 days that season, which was great.
And is it still your favorite hill?
Yeah, although, I mean, I ski so rarely now, especially because I have kids and they haven't, quite gotten old enough to get into it. Like, it's... I miss it. It's something that I would love to do more of. My roommate kept it up a lot better than I did. And actually, he's been wiser than me in many ways because he kept going to San Francisco and started working after we spent our year on the mountain.
Yep.
He joined a company in 2003 that was, that I kind of heard of, that was just getting going, called Google. And I decided to come back to Wall Street. So he's okay.
Okay. So you come back to Wall Street. Do you eventually get your sell side job that you're looking for on the trading desk?
I did, but I actually had to spend a few years on the buy side first.
Okay.
I went to a mutual fund as an analyst, and it was an international small mid cap desk with maybe like $2 billion under management, a couple of senior analysts and a PM. And because it was international small cap, but it was XEM, it was just DM. So it was Europe, Japan, Taiwan, Korea, and tucked away at the ass end of the benchmark was Australia and New Zealand. And this is the early 2000s. The look back in the market had been 10 years of US and 10 years of large cap. But we were just getting going in 2003, right? With the whole super cycle and international equity. Feels a lot like today, right?
Okay.
Maybe, knock on wood. And nobody had covered Australia and New Zealand because it's 24 hours out of your life each way. So they threw it to me and they were like, hey, why don't you take a trip out there? They actually flew me coach the first time I went. So I've had the experience of sitting upright for, almost 24 hours, but I had a blast. You're in your 20s, you're going to the other end of the world. You've never been. And like my first meetings were on the Gold Coast with Billabong. Like the CFO walks in trunks and I'm sitting there with a jacket and tie.
Come on, really?
Yeah, amazing. Yeah. I had no idea what I was doing, But I did that for a few years, and being on the buy side, back then they had coverage for everything. The street, consolidated a lot over the last 20 years, but regionally they actually had desks that focused on Australia here in New York. In fact, the guy who used to cover me from Citi, he was a Kiwi, who had been a New Zealand equity salesman in the 80s during the wave of privatizations and then moved up to do Australia and New Zealand. Today in New York, if you run across an Aussie in equity sales, it's probably because he used to do Aussie equities and then they folded all of that into Asia. And he just happens to be the Aussie specialist who sells Asia Pac because there's not enough money to do one country, one market, you know?
Oh, okay.
All
right. So you're there.
Did that for a while.
And then you say, finally, I got my job on the sell side.
Yeah, my coverage pulled me to the other side of the phone call to another major bulge bracket, and I was there for a couple of years and basically surfed the super cycle. And the gig was interesting because while I was still on the buy side before the move, the way they would kind of try to divvy up responsibility was you have country, right? So I did Aussie and New Zealand, but then they also want you to kind of dovetail sector coverage in sort of a matrix. So the people you want country coverage so you don't have to fly the same, different people have to fly to Japan all year, right? But the person who covered Korea and Taiwan was also the tech coverage globally, right? For me, it was, your sectors will be commodities, oil and gas, metals and mining, as well as the geographic kind of slant. So when I got to this bulge bracket, originally the gig was kind of Aussie, / Asian equities, but quickly sort of morphed into more of a broader cross asset commodity equity focused role. So if like, an Osprey wanted to do long BHP and short copper futures against it, like I'd be somebody that they'd speak to from the international equity desk.
Okay.
And I surfed that massive wave of the whole China coming out, lifting all boats party from 2005 until the crisis in 2008. And lots of fun. I mean, the trading floor in the 2000s was nothing like what you would hear about in the 80s and 90s with all the debauchery and, insanity and stuff. But you still have like some pretty fun stuff because you have a lot of hands who were there from the 80s and 90s. And
they're still trying to get you guys in trouble. Do you have any good stories?
Yeah. Yeah, I mean, nothing truly racy, right? I mean, stuff would happen when you go out at night with clients, but like nothing too terrible. I mean, this is equities. If I had been in FX, I'd probably be dead by now. But
so we were talking earlier. You were talking about the intern that has to eat the food. What was your food? Like everyone's got a story like that. What was your intern? Well, what did the stupid guy say he could do?
July and August on the trading floor gets pretty slow. Traders get antsy, they get pretty bored. So Friday rolls around, who's going to pay White Castle. And so you've got like different MDs on the trading desk, basically arguing about who's going to pay the bill. All right, let's go and get 50 White Castle burgers. You got to send the kid in a cab. Right. Cause last I remember, like the nearest White Castle was a few miles away. So kid leaves at 10:30 in the morning to fill this order, comes back with, multiple bags of White Castle burgers. Guys start drifting over. And now it's, the argument begins like, who's going to pay for it? So you like an intern from each side of the desk now has to face off on who can eat more burgers. And usually
the MDs
it ends,
had like the
MDs would not participate. They would pay the bill. It was the interns who would get the hazing, like the first or second year analysts. These kids are like 23, 24, and poor kids, man. There was I do vividly remember one time being like down the aisle near the windows and just hearing half the floor go, oh, like all at the same time. It's like 2:00 on a Friday, right? There's nothing going on. And immediately, like, you just start to get the smell, and like people, you hear from osmosis, like, yeah, no, one of the kids just yacked it all up, like couldn't make it.
Whenever those bets happen, they always bite off more than they can chew in terms of like, oh, I can eat 6 McDonald's Big Macs in 20 minutes or whatever the bet is. It always ends up being way more difficult than everyone anticipates, and you should always bet against them doing it.
Oh, you want to be really careful, especially if you're like 23, 24, 25, like, and you want to talk a big game and you try to do a chest bump or a cheer.
Yeah.
Oh man. Like,
don't do it.
Don't do it.
Keep your mouth shut. Keep your mouth shut.
I know it's like the floor rewards confidence, but it so rarely goes your way.
Okay. So you're there until let me just get this straight. You're focusing on commodities, like that is your focus.
Yeah, from the international equity desk. Yeah. So, this was at a time when a lot of the mid cap space started to disappear, and hedge funds were really getting, hedge funds were getting really big, and they were drifting into international equities and commodity related equities and cross asset in a big way. So, as that was happening and the super cycle was roofing commodity prices, you had a huge wave of M&A. So, hedge funds might require different specialized coverage, but from the same guy. So, you cover a hedge fund and Phelps Dodge is now in play, right? Or like Vale is bidding Inco, or Xstrata is fighting, for Falcon Bridge. Like all of these names are disappearing, but they're huge names. They're bids and counter bids. You got guys running major M&A arb lines, relative value. I mean, special situations all over the place. It was just a very active scene in oil and gas, and especially metals and mining, for a couple of years. And it actually culminated with, BHP tried to buy Rio Tinto, like almost at the top in, I think, late 07, early 08. Yeah.
Yeah,
that one was never consummated.
You named two of our Canadian names that are both gone.
I know.
It's kind of sad. Falconbridge and Inco. Like you go up to Sudbury and you see all these foreign names anymore. You don't see the good old Canadian names. Okay, so you're doing that, and what happens from there? Like, walk us through the rest of your career.
So I happen to be in a position where you could kind of see over into other strategies in an unusual way. And one day I'm outside, it's kind of late 07, like late summer, very quiet. There are a couple of guys from another floor. I used to smoke cigarettes back then. And there are a couple of guys from another floor, who were like quants and MBS and like crazy structured product stuff. And they had a whole floor dedicated to this stuff. And it's scary sounding. I have no idea. They're all brainiacs. They all took finance theory up the wazoo and make a lot more money than simple, cash equity guys. And their hands are shaking, and it's like a Wednesday morning. I'm like, wow, like, you guys had a rough night, huh? And they're lighting the next cigarette with the last one, right? These guys have clearly been out there for more than 10 minutes. And they say, no, we were here. And I had that classic moment, like from the Margin Call movie, where I'm like, what happened? And they're like, yeah, you're not going to believe this, but we lost $1 billion yesterday.
Oh my God.
And I'm like, Jesus, like this is 2007. So the first thing that pops into your head, like the last time something like this happened was 98 with LTCM. And that was 4 billion. You're like, you lost a quarter of LTCM in a day. And they go, no, that's not even the worst part. I'm like, it gets worse. They go, we know we're going to lose $1 billion today and another $1 billion tomorrow, and there's nothing we can do about it because the market's just not there.
Jesus.
And I was like, I need to read up on all of what the hell you guys have been doing. And then somebody dropped me, Bill Ackman from Pershing Square. He had like 150 slide deck on why he was short the monolines, MBIA and AMBAC. You remember those names?
Yeah, for sure.
So these guys, they were like these sleepy insurers that used to wrap municipal bonds for like a couple of bips because munis would never default. Nobody cared about these insurers, and these reinsurers decided to get into the subprime, asset-backed game. And so they were part of this whole shell game of, Moody's and S&P will stamp it AAA. And in order to get them to stamp it as AAA, you go to MBIA or AMBAC and they'll insure it in the event of default. But the top tranche never defaults anyway, because real estate prices will never do what needs to happen to, for this stuff to blow up at the super senior level. Right.
Or so the theory.
So the theory went, and I knew none of this stuff. I mean, it was crazy. Right. But it was 150 pages, and the first 100 pages are just trying to explain to you like what subprime is and how this works.
Right.
And by the time you get to the end of it, you're like, my God, like my bank is going to blow up, right? Because I'm working for one of the biggest players in this stuff on the street, like big bulge bracket, and having seen banks get into trouble with Elliott Spitzer and like all the other stuff in the early 2000s with the Chinese wall thing and the research ratings and whatever. I'm like, this is a big one. This bank might actually fold. And they had a lot of unvested equity from bonuses and stuff tied up in the firm. And so I went to my boss after bonus day and I was like, listen, I know this is going to sound crazy. I just want to leave with what I've earned. I want to leave the right way. You got to riff me out. I'm going to go back to the buy side anyway. I'm the original ideas kind of generating machine on the desk. And, we know, like, I'm not going to be a broker for the next 30 years. So like, let me go,
Yeah.
And it took actually like 4 or 5 months to get it done, which I was shocked at. Like, but it was also, a different time where like you could go to your boss on Wall Street if you trusted him enough and have these kind of conversations. Today it's like nobody has any loyalty to anyone. And he let me go. I managed to get out like 2 months after Bear blew up in May.
Okay.
Thinking I'd be on the beach for a couple of months and then go back to the buy side, and then the world ended, right? So I was out for almost a year. That was the end of chapter 1. Chapter 2, like the quick version, is I ended up on the buy side as a marketer for a third-party marketing firm for hedge funds.
Yeah.
And it was like going to hedge fund college, because now it's one thing to be like a hedge fund salesman on the sell side talking to PMs. It's another to be his marketer in the room, hearing him put the portfolio together and then walking potential LPs through examples. But you're doing it not married to one fund, but doing it on a third-party basis. I hated the work. It was too slow for me. But like, imagine looking over the shoulders of a human CTA, a long short event driven guy, a special situation distressed guy. One of the guys we repped was actually a structured credit fund that was buying all of the subprime stuff that had blown up the year before for like 5 cents on the dollar. And, they're talking about like, okay, let's get the bid list together for the end of the day. I'm like, what the hell is a bid list? How do you guys trade these bonds? So you learning like through osmosis just by being in the room with these guys. It's like going to college for hedge funds. It was amazing from a learning experience. I did it for a few years. It wasn't for me. That was chapter 2. And then chapter 3 was just the last kind of 10 years focusing on emerging market equities in LATAM. I figured, I had the commodity equity skill set. EM has a lot in common. I speak Portuguese, got the passport, know my way around. Why not dovetail all of these random experiences and skill sets into kind of like an equities role on the sell side again, but focused more on Latin America and other emerging markets. And kind of did that for the last 10 years. Obviously out of that now.
Okay. Actually, I'd love to ask you a question, because you started your career right as like VWAP and electronic trading was starting to grab a real foothold. And I would say when you started, maybe half or even maybe a quarter of it was electronic, and everything else was still like over the phone and traders putting in orders. And now we've gone almost all VWAP. I'd love to hear how the sell side trading job has evolved in the 20 years over your career.
Yeah, it's well, my interfacing with clients was more as a sales role rather than a market making or trading role.
Okay, but you must have still dealing with the traders and stuff.
Sure.
Yeah. So you were true more like a sales
trading.
Yeah.
It's clear that the advent of the algo and the child order and the need to move 1 million shares in the block, as opposed to just lob it into the darks, and the fragmentation of the market topology, as it were, is real. I think that I used to joke, like, whose job is going to disappear first on the sell side, the trader, the sales trader, or the salesman or woman. And it's funny, all three still exist. I have to think that ironically enough, the one that is most client facing is the one that has kind of the most staying power. So
for sure, because that's the one that you add value. You can still do personal stuff.
Exactly. So I think if traders have been able to navigate the transition from, pit to screen, from screen to full blown electronic, and have been able to keep up on the relationship side of the equation, there will always be a role for that. But also, relationships are increasingly overrated, in the sense that you think you have relationships, and then one day you walk into an office and you're riffed out and your career's over after 20 years. And, all of your clients call up and they're fuming, and they're going to put your bank in the box for a while. And suddenly you look up, a couple of months later, nobody cares anymore, and it's back to business as usual. And so I'm always kind of a little skeptical when people say, I've got great relationships. I cover Fido, Wellington. Like I'm on the plane to Boston twice a week. I'm like, dude.
My old man, he went one time he was in the business and he went down to the New York Stock Exchange floor and they used to talk about how, there's a lot of value added. We get better fills for our client. And he was always like, okay, if everyone's getting better fills, who's getting the worst fills?
Right. Who are you ripping off?
Exactly. He's like, someone's got to be losing here if you're somehow adding value this way. Do you think that it's changed the nature of how the way stocks trade? Because I do. I really do believe that these algos have created trend days that almost seem mindless.
Oh, yeah. And actually, this goes back a long way. I remember, so there's a fellow that a lot of people will know on financial Twitter, Ben Hunt, who writes the Epsilon Theory. He actually ran a hedge fund for a few years, and I had opportunity to look over his shoulder a little bit. And in his prior life, before he ever thought about Epsilon, I know he's become a little controversial post-COVID, with certain views on the virus, et cetera. But that, like, make no mistake, that guy is dangerously smart. I mean, intelligent to a level where I learned something from him like all the time. And back then I remember him working for a long short fund and his letters used to get thrown up on Zero Hedge. And this guy started writing about the fragmentation of the market, the rise of HFT. This is like late 09, early 10.
Yeah.
And he's literally yelling at people in his letters, like, we are going to have a move intraday one day that's going to rival 87. It's going to happen fast. And like, we're going to look up and like an hour later, we're going to be down 20% or something crazy because the entire market, 90% plus of the volume, are high frequency trading, market making machines that the moment they run into a situation that they don't understand, their job is to shut down and walk away. The market is not that anymore per se because HFT kind of came and went. Like they're still around, but they're not as present in the market in that kind of traditional 2010 sense. But the guy literally called the flash crash months before it happened.
Right.
Like I still remember, like I still have a copy of the letter here. It's when you hear about zero DTE now and the sort of short-termism of how the tail not only wags the dog in options, but how guys are literally like the models can't account for like being long or short vol for a few hours because it requires you to think like in increments of a day when you run the box. Like there's so many kind of parallels today as I see it that harken back to a fragmentation that long since happened. And I remember when the flash crash happened, a buddy of mine was like, he was so pissed off because like he called his specialist on the floor to try to get some trading done. And the guy didn't answer the phone. And I'm like, yeah, because it's like three guys. You guys did that to them. Like you destroyed the floor and now you need them more than ever for like 20 minutes while the market is crashing. And they're not picking up the phone because like they all got fired. Like it's crazy, but like the human touch used to matter. And it can be argued that it created a certain sense, sets of inefficiencies and frictions in the marketplace and what have you. But like, as with everything with liquidity, when you really need it, nobody's there to answer the phone. And today it's just machines that will throw their hands up, shut down, walk away and see what happens. The market remains fragmented. But I think there are other things at play now, right? Like, passive wasn't as big a thing in 2010 as it is today. The things that we talk about, you and I on the side about forcing functions, buybacks and equities and passive flow versus, the forcing function in fixed income, what Yellen and Powell are going to do are more important than any fundamental work on the bond market ever mattered. You know what I mean? Like,
okay, that's a great segue. Let's start talking about the market and start talking about your views. Let's start with the bond market. Because I happen to think it's one of the most mispriced things out there. And I'm continually amazed at how everyone is just buying. And yet they're sitting here and inflation is continually, stubborn. And not only that, the Fed's shown you that they're actually going to be easier than you expect. So the reality is that they're not in your looking out for your best interest as a long-term bond holder. I'd love to hear your views and whether you share my worry about the bond market.
I do. Disclaimer, having now discussed my background, if it's equities and commodities, I can keep up. Bonds, I know enough to be dangerous. I've never had occasion to trade it institutionally in that kind of setting. So it's more of a pick it up through osmosis and experience around the edges over the last 20 odd years. And I speak as an observer, but ironically, short the long end today is one of the largest positions that I have. The sizing obviously has ebbed and flowed over the last couple of years, but I remain very concerned because, and this kind of ties into the bigger framework of how the world has changed and the sort of regime change that we've seen over the last few years post-COVID. Nothing I'm saying is probably going to shock people who listen to your show, and a lot of ink has been written in the last 2 years, especially post 2022, where bonds and equities both stopped working and went down together and kind of shocked everybody that maybe we're in a new world where that kind of historical relationship that so benefited 40 years of 60-40 and risk parity and diversification across assets may be coming to an end. And this might be something else. To my mind, I think it's part and parcel of we know that economic systems want to inflate over time because it allows politicians and policymakers to hide sins and distract people from the source of problems. But monetary policy in inflating assets, and almost like I think of the equity market over the last 15 years, pre-COVID, or 12 years, like from crisis to COVID, great financial crisis to COVID, as sort of like a giant capacitor that would just soak up whatever the Fed was doing, right? And that's where your Gini coefficient started to blow out in the U.S., why tech bros, crushed it and became billionaires. The change now where fiscal matters as much or more, fiscal dominance was not a thing 2 or 3 years ago. Like most American investors had never heard of the term.
Yes.
And they're starting to learn that now.
Can I jump in here and actually, because I'd like to give you a big shout out. You, after your kind of EM background, have been harking on this for a long time and been saying, no, we've seen this playbook before because they've done it in Brazil, they've done it in Argentina. And it almost seems to me that the Brazilians and those people that have been trading those EM markets for a long time understood this cycle better than all of the developed market folks that were stuck in this idea of kind of a Japanification / Europe / US when it had clearly changed. Yeah.
Well, I mean, it's self-serving for me to say that, but and I'm not alone in thinking this to be sure, but I think that there are the fiscal coming out guns blazing the way it has since COVID, and then not being transitory. The whole we'll mail people checks, but then we're going to get religion, just not yet. Like we'll get chastity and virtue and all the rest of it, but like only in 21. The fact that like there is zero political appetite in America to even discuss deficits is this is a feeling that Brazilians know very well, and it's one where we've always known that the short-termism of the election cycle and the advent of the career politician who doesn't go home to grow his own crops or run his own business, he is in the business of trafficking in the currency of power and making a living at that over the decades, has created a sort of a feedback loop where you are constantly trying to get reelected or put out a problem, but you will not address something ahead of time because you will never be reelected for solving a problem that didn't happen. So I remember hearing, I was in DC with a few guys in 2013 or 14, and Druck had just done his college tour, trying to educate the young folk on how they're going to get royally screwed and ripped off once the boomers work through, the pig through the python of demographics and take their Social Security and their Medicare, and the younger generation is going to be the one to pay for it all. And politicians just did not care because the younger people vote less, and they have fewer assets. I mean, the boomers today are 20% of the population, but they're 50% of assets.
Right.
The millennials are actually a bigger cohort. They're like 25-ish% of the population. They're like 6% of assets in America.
But they're starting to vote now.
They're starting to vote, but because guys are starting to wake up and realize, like, you know, I'm getting poor. You know, a slice of pizza in New York now costs $4. You know, like it's.
But the ironic thing is, yes. So the funny part about it though is, if we go and we get religion like the boomers want us to, in terms of cranking rates and slowing the economy, that's not actually going to solve the problem.
No, I almost feel like we're too far gone. And in a way, this is also a feeling that Brazilians and Turks and South Africans know very well. It is not a zero hedge, like straight to my veins, like guns and butter, gold bars, farm in, you know, like protect yourself. Like, oh, are you a billionaire? Good. You've got the bunker in Oklahoma, or you like donated the art to New Zealand in exchange for a passport. Like, that's not what this is. Life does go on.
Right.
But it is, we are actually hitting this now at a time when for the last 40 years is a long time. That's 2 careers on Wall Street, like almost 2 generations of people now who for the most part, unless you had occasion to really spend time and live and breathe in an emerging market that has dealt with fiscal dominance in the past, it's kind of Christmas for people like us in America, because I know exactly what to do with this place. Like, I know exactly where the next trades are and the trades after the trades.
Right.
are.
And just to be clear, you're talking about, you know exactly what to do in terms of setting up a portfolio, take advantage of what you've seen before.
Exactly. And I know that sounds cocky. Like, you need a certain level of confidence and, hey, I've seen this before somewhere else. I think I know what to do with this. But when I stop and I look around and I think what the industry is today, you know, overrun with long only managers who are desperately trying not to turn over name count, who trying not to lose assets to passive, pod shops that are taking 90 cents out of every dollar going into hedge fund allocations. It used to be 80-20, right? Like the 80-20 rule. Any fund north of $1 billion would get, 80 cents of every dollar. Now it's like 99 cents of every dollar goes to $5 billion and up. Right. And maybe 95% of every new dollar is going to a pod shop. But the people who are working in this business, and not just analysts, but PMs who used to be stock pickers and analysts themselves before they got their kind of sidecar book under the PM, and then, were given their own shot at Millennium or wherever, they've come up in an environment where, there's a level of groupthink from a career perspective that there's just no familiarity with what is going on in the fiscal and what these terms fiscal dominance may do to the relationships between equities and bonds and commodities, to things that we have taken for granted. And I'm not even talking about like a structural 40-year bull market in duration and bonds, and Ray Dalio taking risk parity from a gleam in his studio apartment's eye to a $100 billion monster. But there's something to the fact that the asset management industry at large, and the way people even save money, has been one way from kind of like a belief heuristic. The best example I can give you actually is this. I don't think this is something you and I have talked about on the side before, is when I started looking at Brazil specifically in 2013. Brazil had been running pretty well for 10 years. Like 2002 to 2012 were solid years for Brazil. The old Brazil that I knew was a sclerotic thing. Growing up as a kid, I'd go to Brazil as a kid during the 1990 to 91 hyperinflation, where prices went up 1,000% in a year. That's 2.5-3% a day. And this is pre-electronics. So I have this memory, and I'm sure people remember this as well, who were down there, where you would go into a supermarket, a convenience store, and you would find the guy in the convenience store that was walking down the aisle with the little ticker thing that would put the sticky with the price on every good, because pre-UPC symbols, you didn't scan it on some red X-ray. Like you would have to go and the person would ring it up on the cashier machine. But you would try to find where that guy was in the store and get ahead of him, because he was taking every price up 2% at midday. So you were getting a cheaper price on goods if you got ahead of him on the shelf.
It was like zero TTEs for just in terms
yeah,
of inflation.
Yeah, exactly. So everybody would do a beeline for the back of the store, get ahead of him, do their shop, and then come back to the front of the store and run the part that they skipped to get ahead of him, right? And then you start thinking, of course, you look at that as a kid and you're like, this is crazy that people behave this way. But like, life still goes on. You pay your groceries, you go home, you have dinner with your family. Like that's just the way you live. Yeah. And I remember thinking to myself, after having the whole Ludwig von Mises libertarian Austrian school injected into my veins in '08, that like the misallocation of resources and capital and inflation is such that if you take it really to an extreme, a business has to hire a guy to do that job. Like think how inefficient and what a waste it is to hire a human being to spend his day putting stickies and having to do it over and over again because you got to take the price up once or twice a day. Yeah. Right. So it's, these are things that like you kind of bring into your experience, and your skill set and you say, okay, like this feels familiar. Like I know what to do with this. And then you talk to people and they're like, nah, man, like I'm a bottom up stock picker, man. I run long short. Like I don't have time for that. And I'm like, okay. Like so the entire, think of the advantage you have being a minority who kind of gets this joke.
Right.
Now, they could put a stop to this eventually and then the goalposts shift and we're playing a different type of poker. But as long as they're playing this poker, everybody else is sitting at the table, like thinking they're playing like, I don't know, like 3-card stud. And you're sitting there. It's like, no, the game is, 5-card draw.
So do you foresee inflation going back to 5, 10%? Like how bad do you think it can get?
So I started talking around July, August on Twitter last year about second inflation wave. And guys who follow me will be sick of hearing it. It's not a chest thump. It's just, it was a very different time where clearly there was a disinflationary pull down, and the official narrative and the sell side narrative was embracing not necessarily that it was transitory, because 2 years is a long time for it to be transitory, but that like the Fed was still in control. They had made a mistake, but they had also cured the mistake and probably done enough to kind of get us back in the realm that we're familiar with. Like, so this will be, COVID was a bad dream for the markets for like 2 months. You blinked and you missed it, right? In terms of risk. But then inflation, sort of the echo of like a year or two, but now it's also done. Like it'll just be a chapter in the history books of like how we did too much, but it's okay now.
Oh, that I agree. And that's consensus. That is what everybody thinks.
And I think that we're at a place now where, 6 months ago, this was still controversial to say, even 3 months ago, but it was very clear that the disinflationary undertow had stopped by the third quarter of last year. The prints were still coming down, but the delta, the second derivative was actually positive. So the prints were coming down more slowly, and the diffusion was actually sort of narrowing in terms of the disinflationary side, okay. But you had to really kind of look under the covers. And the experience from being in EM is when this starts to happen, a central bank needs to stay as hawkish as freaking possible, because the moment you try to chase the market lower with a narrative, you're committing the mistake. You're not going to see the result for 6 to 12 months, but you're committing the mistake by telling everybody what they already know, which is, yes, inflation is coming back down. So that will give us some room to potentially chase inflation down the screen with rates. The moment you say that, you compromise, because you haven't fixed the fiscal. The fiscal is still pushing against you. So you've got this giant guy rowing the boat in opposition to what you've been doing. And you just decided to take a break and rest your arms from a narrative perspective. This is something that we've seen in Brazil a lot over the decades. And I honestly, I don't think that Powell or the FOMC did it to placate, the Wall Street banks, or they spend too much time talking with economists and I think it's kind of all of the above, but like it's more that they just don't know because they don't have the relevant experience. In like the central banker of Brazil, Roberto Campos Neto, this guy comes from a treasury desk at a bank. So he has personally wrangled the bond market. He's traded that stuff, right? He knows how to fool the market. And he spends half his time pushing back against Lula and trying to, not pick a fight with this congressman or that. But like, so like, we don't even have those problems yet, right? Like we don't have, I mean, Warren, and you've got some people like trying to lay this all at the Fed, but you need a certain level of expertise, because these guys are living in the last 40 years where forward guidance and communication mattered.
But do you think that they could have actually done anything to stop it? Like, I hear you that maybe he shouldn't have pivoted right now, but was it really gonna like wasn't the rower with the big arms actually going to overpower him no matter almost what?
I mean, it's parallel universes or alternate universes. Like, we don't live in those, right? So I'd like to think that his forward guy, I guess I would put it this way: forward guidance and all of these guys and their verbal diarrhea out of the FOMs. I mean, there were like 4 of them talking yesterday, 3 the day before. It's so much noise, it stops actually having signal at all. Because that they're going to do the politically expedient thing. But to your question, I think there would be more credibility from the top if you had the occasional leaked article about Powell having a behind closed doors, open hearts with congressional leaders of both sides, telling them we are doing what we can, but there's an issue with the fiscal. In Brazil, these negotiations happen out in the open. It's amazing, but like, it's always leaked into the press what guys think without giving direct quotes.
Oh, so your argument is that Powell has to be the one telling them, if you don't pull back on the fiscal, you're going to make me raise rates.
Yeah, I mean, I know.
No, I understand that argument.
I know it's not the mandate, right? And but like him, like doing the, whoa, buddy, like fiscal is fiscal is Congress. I'm not Congress, because like they have oversight of him and he doesn't want to pick a fight, right?
No, that makes complete sense. I get what
but
you're
these
saying.
People don't they don't have a background in the marketplace. Like 10 years ago, when Druck was doing his college tour, I was in a room with a congressman, and somebody else was like, guys, have you seen the numbers? In 15 years, we're screwed. Like, this is going to get nasty. And the congressman said, I forget who it was. He says, where's the 10-year? And somebody said, oh, like 3. And he's like, so what's the problem? And it's like, there is your problem, right? Like, these people will not listen to you until there's a crisis. Like, I think it's Hartnett from Merrill who loves to say, or at least was the first one to say, and it's one of my favorites, the market stops panicking when policymakers start panicking.
Yes. And to your other point, though, Bill Flickenstein always says that this will continue until the bond market takes the keys away.
Yeah. And it's sort of saying the same, right? Like, and in a way, the outcome eventually when it happens is that much more shocking and acute, because the bond market, along with risk in general, is run by people, again, for 40 years, pro-cyclicality, a few bumps along the way. Okay, the 01, 02, 08, these were big bumps, but 40 years kind of in one direction. You're living in a world. If I can back up and give you a framework, Kevin, to kind of round out this picture.
Sure.
The first thing that I did when I started covering as a sell side focused on LATAM and emerging markets 10 years ago was it was within the first 6 months, I realized, man, this is really interesting. Brazil has been one way for 10 years. There was a brief episode in 08, but actually, if you remember, commodities peaked very late. U.S. equities had a high in October of 07. At 1576, I think, on the S&P. Credit had already started to deteriorate in early 07. I think the high, quote unquote, for guys in that world was like February, when HSBC warned and New Century Financial fell down the stairs, and all these little brokers, countrywide started like to have problems. So 07 was already shaky. And then you had like the little quake of Global Alpha at Goldman Sachs, this quant fund, blew up in like a couple of days in July of 07. But then we shook it off and we went to new highs by October. But man, the dollar continued to sell off into 08. You had SocGen blow up in January with Jerome Kerviel, and then the double tap with Bear Stearns in March. And then everybody's like, oh, well, Bear Stearns is the sacrificial lamb. They're the one who didn't play ball with LTCM behind closed doors in 98. So the Fed put them on the altar just to like check moral hazard a little bit here. And now we can all move on, right? And, we had this big relief rally in April, May. And commodities went to the moon that year. The all-time high in oil was like 147 in July of 08. And literally 2 months later, the world ended with Lehman, right? Brazil had a similar experience. The equities mooned well into 08. And then when Lehman happened, we had like a 3-month collapse in the Bovespa. It was sharp, but the rate world didn't move the way people expected. Like if you had told me that we were going to have a global financial crisis, what would Brazilian rates do? I'd say, oh, like 50%, just blowout, right? Like maybe triple digits. Man, I think like rates went out to like 20, 25 on local currency and then came right back in a few months later. The Bovespa was down like 60 in a month and then came right back. It was like COVID for them. So Brazil, like what we had in COVID, like the shock was Brazil in 08. And that kind of cemented for people coming out of that whole like, oh, you know, if this was just like a temporary affair and you can't hold Brazil down even with a global financial crisis, like I really want to be like EM, you know, to the chest, right? And so 02 to 12 was a Brazil that was an aberration in history where you have a 45-degree line of, you know, the economy, output, you know, the market, right? A very long wavelength and a very shallow amplitude. So for 10 years, you could get the tiger fundamental long short guys who need the style drift to chase, you know, in the edges, right? Allocating to their 2 or 3 favorite long-term growth names in Brazil, playing for their 3-year double, 5-year triple kind of book. And this ended with EM versus DM peaking out in 11, 12. And I come in 13 and I'm like, what if the worm has turned here for Brazil? And the last 10 years were an aberration. And the real Brazil is the one that I know from my lifetime and the last 200 years of Brazilian history, you know, always the country of the future, never of the present.
But the nicest people out there, though.
But not only the nicest people, but also black belts when it comes to macro. Have you noticed how like Brazilians punch above their weight
100%. All the Brazilian macros crushed it. This
man. Yeah. Multi-mercado PMs in Rio and Sao Paulo. You don't mess with these guys.
Completely
you don't screw with these guys, right? Like for considering like how many financial people live in financial centers around the world, that Brazil punches above its weight when it comes to macro because you have to, like, you know, this is Brazil. So my thinking in 13, coming in with a fresh set of eyes, but with this past kind of equity and commodity experience, is if the last 10 years was the exception and not the rule, then maybe the line isn't 45 degrees, it's shallow, like 10 degrees. And maybe the wavelengths aren't wide, you know, like 8 years and then the dip in the crisis and then another 3 or 4 years. Maybe like it's 2 or 3 years tops, right? And maybe the amplitudes are extreme. Whether you're talking about equity returns or, you know, like the Bovespa in dollar term, take a look at a chart of EWZ and you'll see what I'm saying. Like from 02 to 12, the thing looks like a straight line. Then it crashes, rips back to a high in 11. And since then, it's been in a wild chop where, like, if you're a trader, it's Christmas, right? But try to do buy and hold for the last 10 years and you've been pulling your hair out, right? Like there's just no way. And if this sounds like the 70s a little bit and like kind of soaking in the old market wizards, like how to manage risk, it is, because the way you make money in a market like Brazil is if your name's double or up 60 to 80%, you reflexively hold your nose and cut it in half, right? And then it halves on you because like maybe Lula comes back or whatever, and you hold your nose and you double the position size and you get in there, especially if you start to see divergence on the chart and whatever. Like it is that kind of market. A buddy of mine used to joke, really good friend, used to say, Brazil's going to be great for you. You're going to crush it. You've got the skill set. You've got the language. You know, you got to go do EM and try to like focus on LATAM while you're doing EM. Okay. He goes, just remember though, Brazil is a market where it's 2 and out. And like what he meant was like, you do 2 years and you string together 2 solid years, start looking for the exit and like brush up your resume, because like within a couple of years after that, you know, you guys are probably in a 4 or 5 year bear market. Like there's nothing sustainable about it. Right. Now, that's Brazil over the last 10 years. Just the sclerotic, shallower, higher amplitude, shorter wavelength, but a trader's paradise.
And do you think that's where we are headed now in the developed or the U.S.?
So if we're all speaking Portuguese and don't even realize it yet, wouldn't it be fitting think of what the returns are like. Like you and I, we joke, like maybe like we're back there in the market wizards where like the human CTA manager who does a little bit by gut feel, but has a process, right? And is looking to fade more than like sit in something. You know, CTAs did great in 22, but boy, they got shot to death in 23 and a lot of stuff trended. It was just, you get wrong weighed, staying too long in a trend. If you're thinking that something's going to run for several years, now you see the other side of the extreme here with the pod shops. These guys are harvesting alpha in air quotes. Within the air quotes, it's not selection, right? Like we all know the joke. They are harvesting the momentum factor on a very short time frame. And then they're coming up with a story afterwards, like, oh, they whiffed on the numbers, or like the whisper, like they guided down, like whatever. The reality is, some of these guys, if they get the joke, they may actually be able to navigate this kind of environment of flatter sort of trend over time, higher amplitude, shorter wavelength. But the problem is that in an environment, this is kind of an aside, but like the danger for them as a business is the economics stop making sense if you're delivering 8, 10, 12% gross or even net, but the book itself is levered up across the firm several times and money's no longer free. And then the allocator, the LP, a lot of these guys, the dirty secret is they're levering their investment in Millennium or what have you 3 or 4 times. So there's leverage embedded in leverage. And it's not that they're going to all lose. I tend to think that this business actually faces a slow bleed, and like classic overcapacity, all the money has gone in there over the last few years. And now it's going to stop returning because it's very hard to deliver uncorrelated, 12% type, like 10% net, 15 to 20% type gross, with a Sharp of 1.5 to 2. And we don't need to get into Sharp and why it's just, it drives me crazy, that conversation. But I tend to think that it's more of a slow bleed for these strategies where the economics just stop making sense because leverage isn't cheap.
Well, so far they're nailing it though is the problem. And it just kind of,
they are,
and they're doing great. And Paulo,
sorry,
it's all right. Paulo, these guys could be your Substack subscribers, buddy.
Oh, they love me. I've got plenty of friends at the pods. They know I love them. Like, I mean, it's not a knock. It's a great business. I mean, Jesus, these guys,
I think that they've actually, the one thing that you mentioned was the fact that the chasing momentum. I think that they are kind of partly responsible for this rolling bubbles thing that I've talked about.
Yes.
And it's that you get, and it's almost like they get into a trade, then people see it and it's behaving well. More people get into the trade. It does better and better and better. And I'm not disagreeing with you that it's going to be choppy, but I almost wonder about, like, we're not going to trend one way for 2 years, but the actual trends seem to be more intense than they used to be in my day and age.
It feels that way to me as well. Certainly if you're anchored to a US equity experience, I think,
like when they come for something, it's just like, holy smokes, they just come for it. And like AI is a perfect example. It was a good idea. A lot of people got into it. And then it just ended up being that at the end of it, it was like people were buying it because it's going up. That's it.
Yeah, it's wild, right? Because I mean, rates are at 5 and you wouldn't expect us to be right back there in 21.
Right.
And I actually wrote a thread on Twitter back in like mid 22. I started to get a little nervous. I've been bearish all year on equities and fixed income. And by June, there was an article on Bloomberg saying short sellers sitting on 300 billion of unrealized profit year to date. And I'm like, whoa, that's a lot. Like, I mean, you start back in the early 2000s and you remember, okay, while you're watching PSI Net and all this other, Connexin and this other stuff going to zero, like you had to squint on a long-term chart, but like there were 100, 200% rips in there where down 90 became down 80 in a couple of weeks.
Oh yeah. People forget right? that. Like and it's so easy to forget. You look at it and go, oh, that's so easy. I would have shorted that and hung on. Yeah. Go have a look.
Oh no.
Even the NASDAQ,
it actually works against you.
Even the NASDAQ had like 18% up days.
Yeah, I think it was you who flagged something like that not long ago, where there was a random day in January of 01 maybe where the NAS was up double digit, like well into double digit on nothing, and or, some headline about the Fed maybe cutting rates, and it's like, you're kidding, right? But part of the mechanic of that is, let's say Carvana, right? You're down from hundreds to 25 by June of 22, down 90. And I'm sitting there looking at this thing and I'm like, okay, I know it's a bagel, right? But like, I've got that feeling, in the back of my neck. I can't shake the fact that this thing maybe has to pop a double before it's on its way to zero. Because what's worse is, if you're a long short guy and you're short, it's not that you want to press, right? Because your conviction gets a little bit less as something falls, unless you're playing for zero. But it's very hard to play for zero. And these guys have been around long enough. Again, all due respect to the pod guys, if you survive, especially given the attrition, like down 3 and it's a warning, down 5 and you're out, like, imagine living that way. Like, you sleep 4 hours a night and you literally,
Paulo,
might as well,
in your PA, you'd be out in a week.
Oh, forget it. I'd be out in 2 days, maybe an afternoon. Come on. And it's so, like, these guys are on all the time. They have to know everything, right? They have to manage themselves and their bosses and the firm at every turn. And so, all due respect to them, they work harder than I do. And one thing that they know very well is that if they want to maintain a balanced net exposure, but the short is down 90, they have to take the share count in their book on the short side up massively, to keep the net stable.
They have to keep selling it on the way down. No, I wrote a piece about that. It's like the math sucks for shorting.
The math is terrible. Yeah. So the most motivated buyer. So this comes to one of the first notes I wrote when I moved over to Substack earlier this year. I called it the forcing function, and there was nothing really groundbreaking in there. I think Kuppy wrote a long note a year ago about how buybacks were the way, like, to cure this. If there's one way to stand athwart the trend of passive flows rewarding mega and tera caps and destroying small cap, especially value, or small cap anti-momentum, it's the buyback, which forces the float tighter. And if the buyback is strong enough and manages to neutralize the active manager, who's a steady offer because he's constantly getting redeemed for the benefit of passive as that rotation continues, then at least you have a chance as an equity holder. But you need the forcing function there. And the forcing function, another forcing function in equity, it's all about a level of motivation, right? Like, because one guy selling is another guy buying. So there's no cash on the sidelines. There's an equilibrium price. Who's more motivated? The most motivated buyer is not the passive. It's not the buyback corporate itself. It's the short seller.
Yes.
Who's over his skis. And now the stock's starting to move against him in a vacuum. That guy, it's like, it reminds me of that chapter of, like, Paul Jones in, PTJ is one of my 3 heroes in Market Wizards, where he's like trading cotton or something. And he's like, he realizes he's on the wrong side or something. And the guy turns to him and, like, it just broke through his level. He knows, like, what Paul holds. He just turns to him and he's like, yeah, if you need to go to the bathroom, you can just go right there. Yeah. Like, that's the feeling when you're short something and you realize it's roofing and it's not going to stop for, like, far longer than you ever imagined. Oh. And, you're just too full. So that guy needs to pay almost any price just to, like, solve the problem.
Okay. Let's talk about some of your picks. What do you got for us? Give me, you've talked a little bit about your short the long end, but you're really not a bond guy. So why don't you give me 2 other themes, ideas that you have?
Sure. So another one of my frameworks, and I could just answer the question in a minute, but why do it in a minute if you can talk for 10 minutes and hear yourself talk, right? Sorry, man. And sorry to the listeners, but again, nothing groundbreaking coming from value in EM and commodities. It feels like long-term trends are changing. Everybody kind of knows this kind of thesis by now, but sort of dovetailing with your rolling crack ups and rolling bubbles, I've noticed, and I think this is important for guys who play in value with a commodity bent. This one is different from the 2000s that I lived through, like the wild times of Phelps Dodge and Falconbridge and whatever, because back then China comes out and, backward dates all commodity curves, pushes everything out to the right, big demand statement. Here we go. This one, there's no obvious coming out party. I mean, you can draw a line around India, and I think it's Louis Vincent Gave from Gave Cal who talks about the 1.5 billion people from Istanbul to Jakarta as like the next China for the next 10 years. But from in the narrative sense, it's the hiss in the universe like radio. But the bigger issue is the underinvestment and the lack of supply side response. And you did an interview earlier this week about copper specifically, and you can extrapolate that to nearly all commodities at this point, where this lack of investment actually moved supply curves in, as opposed to a demand curve being pushed out and the tide lifting all boats like China.
Okay.
And what this does, in my experience, like why this super cycle, if you want to use that word, feels different, is because underinvestment sort of hits the skids at different times, and you have substitution effects. So if copper gets really expensive, guys will flip to alley. If nat gas gets really expensive, guys will flip to thermal coal. There are things that happen amidst these crack ups. So classic example. And I credit you actually for the inspiration, because you used to talk about rolling bubbles, and I was like, I'm kind of seeing this in commodity pricing. And it's weird because this isn't like, dollar down, dollar up, commodities down, right? This is something else. And I first noticed that when TTF, nat gas in Europe, which nobody had ever heard of until the fall of 21, right before the invasion, roofed, took thermal coal with it. Then February, the LME blew up on the nickel trade, right? That Chinese short seller billionaire like got caught wrong way. Nickel went to 5x. They busted all the trades, and Russia went in, roofed oil. Nat gas then did its thing. Henry Hub had a huge run in the shoulder season in the second quarter, April to June, took off. So you have this experience where what's causing this, like the substrate is underinvestment, and the supply curve coming in is creating this effect of constant substitution and crack-ups happening at different times. But the crack-ups happen from a point of invisibility. So it's not enough to be a fade at all turns, like, oh, okay, I'm going to short what people are really bowled up on, because that'll have killed you if you started to do that 6 months ago in AI. And, buying stuff that guys are really bearish on. I mean, look at the ags, like soybeans, corn, whatever. Like, my God, it's been just a year and a half. And every day I wake up and I think today's the day, and still waiting for that magical turn. But it's not enough to be a contrarian. This dovetails into look at what's turning invisible and has just gone to sleep, but where the fundamentals continue to tighten under the covers. Uranium is a classic example last year, and this well through Kuppy, our friend, who, and several other smart guys out there who are really in the weeds on this commodity. Kuppy comes out with this reflexivity thesis. Oh, Sprut's gonna, the Sput Trust is gonna roof uranium because it trades at a premium. They issue shares. It's like just doing a follow-on all day to buy physical. They clean up the physical market. The physical roofs makes retail want to buy spot, and around we go to 1,000, right? The guy drops that thesis, and uranium ripped for 2 months in 21, and then went to sleep, in a wide range, but kind of had to chop wood for 18 months to a point where people just forgot about it.
Yep.
But behind all of that, through all of 22, you had just a parade of bullish catalysts. Now, uranium wasn't going down in the face of bullish catalysts. You and I, as speculators and longer-term investors, mix of both, will know that anything that's going down amidst bullish catalysts is a disaster. Don't be there. But something that's chopping wood and not getting rewarded for bullish catalysts, this market just continued to tighten. Oh, Europe is including it for subsidies, this, that, and the other. The Japanese are turning the reactors on. It was just a parade for 18 months of good news, and the price just went nowhere, to the point where guys stopped even being frustrated or hating it. It didn't matter. And then, it goes quiet, right? And, the look back on realized vol gets lower and lower and lower. And then you get a life extension for Diablo Canyon in California, which is 10% of California's baseload. It's 2 reactors on the coast, a gigawatt each, 1 million pounds a year each. And they wanted to shut this thing to 10% of baseload in a state where the lights already go out, in the summer. So they extended the life. And the issue here, going back to forcing functions in commodities, in equities, it's the most motivated buyer and the hum of the passive and price insensitive buyer. The price insensitive buyer in a commodity is a guy who needs it tomorrow, right? And the only way you tighten the market up and see real price discovery at the margin is to get a guy to say, I'm bid X but I need it next month. And the equivalent of that in uranium, for example, is, you've got all this spot material around. Nobody really knows how much is out there, but a life extension is interesting, especially if it's either a reactivation. Those usually take time, but like telling Diablo Canyon, okay, you're not shutting down at the end of 23 and it's May, or it's March, I think was the vote. These guys have been selling down the 3 years that they keep on site for the rods, the 1.5, 2 core loadings they have. They've been selling it down because they're not going to need it in 25 and 26. And now it's April. They've got their life extension. They need to keep the thing humming for the next 20 years. And they've got to backfill 24 and 25 and 26.
Right. And so do you think that's what's happening in copper right now? Is that your argument?
I think
that we're in the sleepy stage?
We were in the sleepy stage. If you had asked me, like, what is the most invisible commodity, I'd say it's copper 6 months ago, even 4 months ago. And then we got hit with this Diablo Canyon RFP in May for 6 million pounds. And the spot price went from 52 to 59 on uranium. In copper, I thought we got that in November. Everybody came out with their year ahead. 24 is another balance to surplus year for copper. And literally a week after everybody's year ahead report in commodities came out, Panama just stopped, right? There goes 300,000 tons. And like 2 days later, Anglo-American warns that they're going to miss another 200,000 tons. And now you have a 500,000 ton swing in balances. And this is a real number because the total primary production is like 20 million tons a year. So you're taking 2.5% that people thought like, okay, we're going to have 500,000, 400,000 to 500,000 surplus in 24, and now it's 0 to negative, right? Like you flipped a deficit on 2 catalysts within the span of a few days. Copper pokes its head up and immediately disappoints everybody again. And I'm sitting here thinking like, man, at some point this stuff is going to matter, but we've been working the length out of this market and disinteresting and frustrating people for 2 years. Like this thing is going to go. It needs the forcing function of guys who need it sooner than people expected amidst a market that has been tightening for a couple of years while positioning went to sleep. I think copper is it now. And the move out of it always surprises people as well, because the move out of it is a function of how long and the level of like max frustration it took to put the thing to sleep in the first place. So when, you know what I mean? So like when guys talk about, like, there are not that many guys who talk about $6, $7 copper, but you're going to reset to a new kind of range of price discovery. You need to start with an assumption that like, not only is that possible, let's say it's likely, run that through your numbers as a base case. Like, what do you get? These are the sorts of things, again, where amplitudes are higher, wavelengths are shorter. You got to be ready to get out as well, but you have to be in there while it's going to sleep. My issue that I've started to refine over the last year or two in kind of getting this joke is that maybe I need to wait for the catalyst and then just go whole hog rather than buying it because it's cheap and it's coiling. You know what I mean? Because you don't want to get shaken out of something after sitting in it for 2 years,
also,
not making any
it's
money.
Also when you buy so much, Paulo.
Yeah, I do stupid stuff. You don't want to know about my edge is not risk management. I just get lucky.
No, you're a terrific trader, and you actually have the conviction to go for it. You're like old school macro, I would call you. You're not playing for the 10% variability. You're definitely going for the George Soros / Steinhardt 100% up years is what you're going for. So I love that part of it. Do you have one more for us?
So again, nothing super controversial here, but besides being short the long end, and I'm trying not to get cute with that. Like you don't want to do the steepener. I'm like, I don't know how much I get paid on a 2 year if like the cuts come out. You're really going to bet on the accident? That was Silicon Valley. Like that was somebody's bad month. I just don't know how I get paid, like trying to duration match and get cute with it. Just short the long end as inflation. So the first trade was shorting the long end, right? I was very aggressively that last year into the hole, and I got lucky. I got out kind of around near the bottom. It felt overdone. But I told guys the trade after the trade is not necessarily just piling into the long end short, but now playing for the fact that inflation expectations start to become unhinged beyond just the first or second year out. And as guys start to question, again, like real term premium questions creep into frame, whether 2 is ever going to be the average or maybe the new average is 3, because you look at the asymmetry for the Fed. The Fed is never going to make up for 9% CPI at one point last year, year over year, with 0.5 for 4 years. They're willing to let that 9 go. But if they get 1% because of an accident on the downside, they're more than willing to let it run 4 or 5% for 6 to 12 months to kind of balance it. That old, it's average inflation targeting, but it's biased to, there are no corner cases on the upside as long as it's transitory. Let's just make sure that we never do 2008 again. Like, they're still thinking that way. And so, like, what that really means to me is the new average for longer term inflation is not 2. Maybe it's not even 3. Maybe, like, we live in a world where we cycle 3 to 7 for a while, and it just kind of swirls like a maelstrom, and nominal growth continues to kind of, like, we never see negative nominal.
Okay. So how do you play that?
And I think, like, to your point, inflation swaps will eventually get sticky and go higher. Break-evens are tricky because, like, they can always fuss with the goalposts on CPI, so you don't get paid as much as you wanted to.
Same with this inflation swaps, though.
True.
Yeah, they're all CPI based.
And I think for retail, like, some of this stuff can get pretty sophisticated anyway. So, or even individuals who just don't want the brain damage of managing this kind of thing. So I think it just comes back to, like, gold is finally ready for prime time. And I started to get pretty vocal about that in the fourth quarter of last year, that, real assets, especially ones that are short duration, cash flow producing, and, the yellow metal, for me, I got very aggressive. I wouldn't rush out and put this on now because the stuff's roofing. And, like, we're now in a moment of skid, as I like to call it. And stuff like this tends to skid on the top side. It'll skid on the downside in a crisis, like everything else. But, you flagged this as well in one of your notes, Kev, like, gold miner, realized vol had fallen to levels where it's like, there's practically no smile on the call side anymore.
Yeah.
Right.
Nobody cares.
So, and this goes back to, like, the framework of, rolling accidents in commodities as people rotate from one to the next, whether it's pod bros driving the price or whether it's the price insensitive, I need physical delivery tomorrow. And then when he's done with nat gas, okay, like, I can't afford, it's no longer economic to do $6 Henry Hub, so I'll take thermal coal at whatever. The rotational, we live in a rotational world, and the kind of substrate of all that is positive nominal growth. Where it gets really tricky and where we'll really be speaking Portuguese is where we end up in a recession, and it doesn't feel like the recessions that we used to have. And what's really happening is inflation is exceeding nominal growth. So technically you are in a real recession. But one of my favorite kind of turns of phrase that people seem to really like is inflationary recessions create monetary illusions. And what I'm really trying to say there is, an inflation where nominal growth is running 3 to 4, but inflation is running 5 to 7, feels very different to the person on the street and to Wall Street and elicits different types of behaviors in asset classes than the classic recession of -2 or -3 nominal, or God forbid an 08 comes along and you get, mid-single digit nominal for a couple of quarters with inflation at 0.
Okay.
Right.
Okay. We're running long, Pat. Paulo.
Sorry.
No, it's great stuff. It's great stuff. So I'm going to have to finish up with the questions. By the way, I do love that line. And you should coin that. Inflationary recessions.
Inflationary recessions.
Monetary illusions. You should make that your tagline. All right. Let's start with, what is the hardest thing to do in trading and investing?
Everybody's going to have a slightly different answer, but as one of the world's most irresponsible risk managers, I can say honestly, admitting that you're wrong, admitting mistakes. And Soros loves to say, like, I love making mistakes, like, because I have an opportunity to correct them. I'm like, okay, like, you're 90 or whatever. Like, that's great. Like, and you're a billionaire. I'm in my 40s with 4 young kids, and I live in New York in a blue state. It's like, it's a little harder, buddy, like, to admit mistakes. Like, it all goes right to the chest. But for me, honestly, it's more than making mistakes. Like, the process actually starts with forgiving yourself. If you've ever taken a really big loss, right, and you know that you were doing the wrong things, and this has happened to me once big, thankfully, early enough in my career that it wasn't a death blow. But these are the stories that don't come out. Like, as we're all kind of chest thumping about how confident we feel when we're like in our zone and running in our lane, and this is my kind of market. Like, the backstory is I've had 3 career chapters in my life. So I'm a bit of a misfit toy in the business, but in my PA and my own personal trading, there was a time where, you know, I went from thinking like, man, I've got this figured out. I did well. Like, I made money in '08, you know? And I was that guy who was thinking that the second Great Depression is right around the corner in 2009, 10, 11, and fought the tape and didn't realize that the rules had changed right underneath my feet. And that, you know, passive, flow, narrative, the world had changed in a way that had left me behind. And I was too young and inexperienced to realize that I had gotten lucky. And thankfully it happened to me at an age before I had a family, before the money, like before the numbers get really big. Cause you don't want to make this mistake when you're 50 with tens of millions.
Hopefully.
But like, to answer your question, for me, it's not just admitting when I'm wrong and making a mistake. Because how you handle the mistake also matters. Like, do you double up? Do you cut? Like, you know, it's not just, oh, like I use stops. Come on, guy. Right. The reality is, like, if you make a big enough mistake, like, the process starts with forgiving yourself.
Yeah.
And I know that's very personal, but if you've ever looked down the hole of like, my career is lost, I need to start over, and I torched a ton of money. Like, most people have never been through that, and I hope they never are. I've been through something.
Yeah,
like that.
I understand that. Like, I get it. You just sit there like, geez, that was so stupid. And you're just like, what was I thinking? And you have to be honest. And I've never thought about that though. Like, forgiving yourself. I'm gonna give some. I'm gonna give myself. I'm gonna go and do some therapy on that, Paulo. So thank you very much. Okay, Don Cox used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any trades or ideas that you feel would get the Don Cox seal of approval?
Now, Kev, I knew you were going to ask that question, and that's actually been the hardest one for me, because if you had asked me that 4 months ago, like at the end of last year, I would have said it's easy. Power infrastructure. This is the way. Like, guys still don't understand how much we need. You know, it's not just the green revolution or the AI and the data centers, just the rehabilitation. It's all of that, right? The grid. But that story's kind of out there now. It's not on page 16 anymore. It's not crowded.
It's not on page 1, but it's on page 3, you're saying.
Yeah, okay. It's like it's moved to the front of the paper. Okay. So I sit here and I think, man, like, what? It's not that it's bearish, because hell, if it's November of '08, the market's on the front page, right? But like, what's gone to sleep? It goes back to what we were talking about. Like, I want to be involved in something that's invisible.
Okay. Yeah.
But that's gone to sleep for a while, but where like the work is tightening under the covers. And the best I can do right now in April, and that's not to suggest to your listeners, like, oh, like, well, none of this is financial advice, obviously, but like, I don't want guys to be like, oh, he was like buying this in April and like it went down for another few months, or you know, or he was wrong. And I'm just saying it's invisible. I got to say, like, you look around the ag space and corn, especially.
Oh yeah.
And here's a market that people got really jacked about with Ukraine and Russia. And then Russia just, you know, crops galore, dumping wheat. You know, here we are in a 2-year bear market, record negative positioning a few months ago. We've cut some of that length back. The price hasn't really responded. It's a little bit off the lows, but now we're like kind of in bumbling along the bottom. We may have to do that for another 6 months. Like, it may need to go invisible to a point where it's like ghosted, right? Where the open interest halves.
Yep.
While the length reduces, you know what I mean? Like that it coils, and then the realized goes to like mid single digits, and nobody ever talks about corn again.
Got it.
But it's gotten pretty invisible.
All right.
And it has my attention.
Patrick O'Shaughnessy often asks his guests, what is the kindest thing someone has done for you to help you along in your career? This is such a great question. I'm going to borrow it from Patrick. Do you have any particular person that stands out for you?
I consider myself living, despite being a misfit toy who's had to kind of pivot his career a few times and start it over. As long as we're talking about the market and careers and not personal life, I've been very fortunate, because I've actually had, with 1 or 2 exceptions, tremendous bosses and rabbi throughout my career. If I can give anyone advice when they're starting out, besides the one that we talked about at the top, you know, like, do the job that nobody's wanted to do for a while, because pretty soon you're going to be like, you know, commodities are in a 10-year bear market. Do Australian commodities. You're going to be having your day in the sun pretty quick. And, your boss will remember you if you cleaned his office. But the other thing I tell people is like, invest in finding a good rabbi.
Got it.
In a bear market, it makes the difference. And I've been fortunate to have more than one. I actually feel like I have multiple ambassadors in my professional life, and more than one of them has fired me or riffed me out, like let me go, because it's the nature of the business. And you know what? I've never been fired badly.
Oh, that's great. And that's a great piece of advice in terms of finding people that will help you along your way on your career.
Find a good rabbi. And I would tweak that by saying, if you're ever in a position to let somebody go, be gentle and think about that, because the way you let somebody go, it's the hardest part of the job, but it makes a lasting impact in somebody's life, feeling like they were let go the right 100%.
Way. All right. So we have the question that the last guest left, and I'm going to actually just paraphrase it because it was a little bit long from Eric. And he said something to the effect of, you're on a 747 and you're in the middle row and you're on one end and someone else is on the other end, and you want to sleep because it's an overnight flight. How long do you go before you claim the seats in the middle?
This is going to sound like such a cop-out. And the funny thing is, of all the things he could have thought to ask, A, I've never heard this before. B, the first business trip I ever did for my career was to go to Australia flying coach. Like, so come on. And so I know, although I didn't have this happen to me on the flight, again, it's the type A and the former salesman coming out of me. But seeing that, I would actually do the uncomfortable thing and strike up a conversation and introduce myself.
Okay.
And try to have like a 15-minute conversation with the guy.
You're going to try to find the win-win where you share it.
Yes, either that, because it's such a long flight. By the way, if you ever fly to Australia, force yourself to stay awake to San Francisco or LA. Yeah. And then you get there at like 2 a.m. and then go to sleep after you're in the air, because like your clock is going to be messed up either way. But just trust me on that. Like, don't fall asleep on the Cali leg. You're going to pay for it. But like, there are ways, it's 15 and a half hours. Like, there are ways to sleep in shifts across that. But like, you also, like, if you're the couple of guys who kind of work that out, or even if he ends up being a dick, like, at least you tried, right? Like, but he's not going to sleep 15 hours. So, like, whatever. I don't want to be the first guy, but, or the second guy. I just like, I want to know the guy's name, and then we figure
I got it. That's the next thing to do. I
don't know. It's a cop.
No, it's a great answer. Paulo, what's your question for the next guest?
I think it'll go back to, and again, every question's personal if you're a person, but this one's very personal, which goes back to the forgiving yourself. Like, if you have ever, and this may not be a question for everyone, but if you've ever had a real screw up that you realize was self-inflicted, whether it's in the market, you're fighting the tape for too long, you torched a ton of money, or something even in your personal life, whatever it is, even if you're the most left brain quant for X market maker, black box, like, we're all people. And at some point, for you to move on, you had to have a true conversation with yourself where you let it go, where you make the decision to like start forgiving yourself, knowing that other people around you have, if they're still in your life, have already forgiven you and want you to move on. Like, don't beat yourself up over like the lost money or whatever. How do you begin the process when you take a big loss like that's self-inflicted, to forgiving yourself and starting to look forward and not backward?
So,
and I'm not talking about, I stopped out, so I went to sweat it out in the gym for 30 minutes. And now
I get it.
Like, no.
I get it.
You know what I mean?
We'll see. Gone are the days where people said, if you had to eat one food for the rest of your life, what would it be?
Yeah, I didn't mean to throw a downer.
No,
man, that's
it's
a real
good. We'll
question.
see you. I know who's the next guest. I hope he enjoys it. All right, Paulo, why don't you tell people about where they can find more about your letter, your Substack, your chat? And one of the things that I just want to emphasize is I really think you were absolutely terrific at writing Twitter threads, like the best out there. No doubt about it. I used to see your Twitter threads and I'd be like, holy smokes, this guy can really put together his thoughts in a way that really makes a lot of sense. You're no longer on Twitter as much. Now you're on the Substack. And luckily there is also that kind of Twitter functionality, the chat function.
Yeah.
So for people that were previously, experiencing your threads and enjoying them on Twitter, you can now do it at Paulo's Substack. Why don't you tell people about it?
Really nice of you. If people are interested, if they're not following me already, on Twitter, I'm Paulo Macro. Paulo is the Brazilian Portuguese spelling, not the Italian OLO thing. Paulo Macro is my handle on Twitter, and on Substack it's the same way. paulomacro.substack.com. Moved to Substack earlier this year, really out of a desire to want to write more long form. The threads were great on Twitter, and I really appreciate you saying that. It's funny. I used to write a really widely read sales note on the street. And it was one of my favorite parts of the job because, as you know, writing is part of the flywheel. I'd like to think I speak pretty well because I think clearly, and I write well because I write what I speak. So the three go together, like think clearly, speak clearly, write clearly, like write how you talk. Yep. Right. That was the best advice I ever got about writing, though I don't consider myself much of a writer. Anyway, long aside, I relish the ability to be able to write long form and kind of flesh something out. Twitter was okay if you could construct a reasonable thread, but I found myself spending a lot of time figuring out how to kind of build those bricks more so than actually thinking about the content and what I wanted to say. Right. And all of this is part of the flywheel of trading and speculating with my own money, as well as kind of longer term investing. So the more that I write, the more I'm being honest with myself, almost like a diary. That boomerangs back on thinking more clearly about the market, and the writing is part of my flywheel and how I think about speculation and trading. Yep. Right. And I know you know exactly what I'm saying. So, if people kind of want to look over my shoulder as I think out loud in that sense, I'm over on Substack. I do spend a little less time on Twitter. Place is a bit of a zoo, can kind of get to you from time to time. I've adopted your policy of just mute them and smile when you think of them yelling into the void, you know. But the Substack's been great.
People that I do that.
Sorry, the nicest guy in the world actually mutes people. No, but like it's been great. People have been really supportive as well. I was a little nervous, doing it at first, but it's been a great outlet for me. I've met. For me, beyond just writing and people supporting it financially, like it's the people I've met in real life from it. I used to meet people from Twitter, guys reach out into my DMs and we grab a drink or whatever. I'm pretty open. Like I have two rules. One, Ben Hunt from Epsilon Theory once wrote a note called "Always Go to the Funeral," and I took that in stride. And it's actually I didn't realize just how important that was, and that's a topic for another conversation. Yeah. But then the other one is like always go to drinks.
Oh, for sure.
You know what I mean? Like don't ever say no to
tell
that.
Your kids that when they're trying to, or anybody that's interested in getting into the markets, always go to, and actually it's probably more than just the markets. All right, Paulo, we have to go. Before we let you go though, I want to plug one more thing. Paulo, he is he's just started committing to chatting with his buddy Le Shrub. If I got that right?
Oh yeah. Thank you for reminding me. So you meet all sorts of interesting people through Twitter, and a friend that I met through Twitter, Le Shrub, it's great. He's a truly nice guy, and real black belt in the markets as well. Very experienced. I've had some of my best conversations about the markets with him, and we touch base pretty regularly, every week or two. Hey, how you doing? 5-10 minutes, just catching up on the market. And he had the idea recently, like, man, we're doing this anyway. And there's a little podcast function on the Substack. He's got one too. He kind of moved over around the same time. And he was like, let's just record our phone call, since we're both like kind of ex-institutional guys from the street, and see if people like it, and just throw it up on our Substack. So we did the first one earlier this week, and it was loads of fun. Like, he's a great guy.
So you guys are not only going to get Paulo's writing, you're not only going to get his chat, you're also going to get his, his chats with the Shrub. Anyways.
Yeah, it's sort of ad hoc, we'll see how it goes.
So go to paulomacros.substack.com. Paulo, thank you so much for your time. It's a real pleasure, buddy.
Thanks. This has been great. I'm less terrified and more excited, actually, and I'd love to do it again. I feel like we barely scratched the surface. I have so many more stories. All right. Yeah, it does.
Thanks, buddy.
Thanks, man.
Bye-bye. All right, we have a special treat, folks. Our good friend of the show, Harris Kupperman, a.k.a. Kuppy, he said, Kev, I got to get on the show. I got something exciting to talk about that I've been waiting a long time. Kuppy, thanks for making time for us, buddy.
Hey, thanks for letting me come on.
Yeah. So you have had this stock that you've been very excited about for a long time, but you're finally at the point where you're willing to talk about it. What is it and why are you so excited about it?
Well, it's been burning a hole in my pocket for over a year. I just didn't feel like the time was right. Quite honestly, I was hoping for another pullback to get a few more, but I don't think it's pulling back, and I feel like it's just time to go tell the story. The stock is AMARK. The ticker is AMRK. This is not a recommendation to do anything. Please do your own work. I'm quite biased as I own a whole lot of stock. So, just get that disclosure out of the way,
Right.
do your own work. But, I want to talk about this company because, look, I'm a crazy raging gold bull, and gold has this thing where it seems like it chops wood for a long time, then it trends. If you look at like 71 to 81, it trended for a decade. From 2002 to 2013, it trended. I mean, everyone right now has PTSD from gold because it's been violently sideways basically for a decade. But they forget that when it trends, it really trends. And I want to find a way to play gold. And this has been, bugging me for a while. And we all know the issues, right? Gold futures, there's a nasty contango right now. You could lever up, but, I expect there to be $100 down days in gold. And I don't want to get, stopped out of it. And I don't want to, have some margin call and get whipped around. I mean, you can play with the options, but similar problems and timing sucks. And we all know the problems with the miners. Look, I mean, over 20 years, gold has been like a 6 or 7 bagger and GDX is unch. That tells you how much leverage there is. And, we've seen these royalty companies become, super popular ways to play gold. But honestly, they're just return of capital Ponzi schemes. They raise money at 40 or 50 times earnings. They reinvest the money at 7 times earnings. They pay you out 1% of the capital each year. And it's kind of like this weird Ponzi economics. And you still have the same risk of mining. I mean, look what happened to Franco-Nevada in Panama. I mean, you think you're getting away from those risks, but you just have a different sort of risk. And so, you have this thing where I think gold's going much higher, and I don't know how to play it, right? You always want some leverage. And I finally found the way to do it. And that's AMARK. AMARK.
All right.
Sorry?
What is it? What is it? What does AMARK do?
Yeah, let's get to that part. So AMARK is a bullion trader. They don't take price risk. They're fully hedged, but they own JM Bullion, which is their DTC retail facing part of the business. They do a lot of wholesale work. When you go to the local coin shop down the street, they're likely buying coins wholesale from AMARK. They deal with government mints around the world. They own depositories. They do all sorts of stuff with gold, right? And they make their money 2 ways. Obviously, transaction volume. And in a bull market, you'd expect the transaction volume to go up. And that's not just them selling coins to people. That's them also buying back coins from people that want to have an exit. They're just making that spread. And, they really make money on the spread. Let's just give you some numbers so you understand the size of this thing. In 2023, fiscal 2023, they sold 2.6 million ounces of gold and 156 million ounces of silver, okay? And at the end of the year, they had about 2.5 million total customers with about 500,000 active customers. So they're a really large piece of the whole commodity, gold and silver market, primarily platinum and a couple other things. But they're really selling coins to people, buying coins back from people, storing coins. And despite doing, all this huge amount of business, I mean, it's important to remember that their gross profit margin was only 3.16%, so 316 basis points. So it's a thin margin business, but that margin fluctuates. And in a bull market, I'd expect that margin to tick up a little. In a bear market, it tends to tick down a little. It's tied to volatility. And so when something's trending, it gets more volatility. You get like a little chance to earn a couple more basis points. But this is how I'm thinking about this company. And this company's been put together over the past decade, mainly through acquisitions, which is interesting because the share count hasn't gone up much. It's mostly them just retaining earnings. It tends to be like a really, really good business. The way I think you should think about this is, you're owning the exchange, right? The stock exchange is a very, very good business. And in the case of JM Bullion, these guys are about a third of the market. There's APMEX, which is the main competitor. They're about another third. And there's another 100 guys that make up the other third. And so you have really this duopoly of a business structure. It's kind of like a stock market. And, you have to ask yourself, do you want to own a shitty miner or do you want to own the stock exchange? I think what's interesting here is if you go back since the current iteration of this, after they bought JM Bullion, In 2021, 22, and 23, they're in something like $7 a share. And there's a bunch of adjustments there. Please go into your financials and do the adjustments yourself. But it's a clean $7 a share. The stock is trading about $30 right now, so call it 5 times normalized. You could ask, why is the stock trading down? And I think what's happened over the last, so call it 9 months, is that gold was in a range. It wasn't doing much. The spreads came down. We see that in the financial numbers. The volumes came down. People got bored. And, you have to remember that from 20 to 23, you had all these crazy things happen that makes people want to buy gold. So gold was in a range. It wasn't breaking out. You have these things that happen and guys say, oh, here it comes. Now I need to get some gold. Go grab my gold. Go get my guns. You had COVID. You had the lockdowns. You had all the crazy money printing of QE. You had the George Floyd riots. You had election chaos. You had Jan 6 and Russia invades and Silicon Valley blows up. I can just keep going on. Like crazy stuff happened. And it made people want to buy gold coins and silver coins. And in the last 9 months, it's kind of just been quiet. And that's why the spreads have come in. And, I think this is a business where when things are really huffing, it does really, really well. And when things are a little quieter now, they're doing about 60 to 80 cents a quarter. Call it $2.5 to $3 run rate at the trough. So you're paying kind of like 10, 12 times trough. And I think this cycle, given all the acquisitions they've done, how much larger the balance sheet is, the fact they bought back about 5% of the shares, I think they can get to $10 a share. Okay. Remember, they'd had 3 years in a row of 7. So it's not like a crazy historic, heroic number, especially if we have a gold breakout bull market and the spreads widen from, 3% to something a little fatter and the volumes go up a bit. And, I'm trying to be conservative, it could be larger. And I think this thing should get a proper market multiple as a super high return on capital exchange. I mean, why is 25 times the $10 they make like crazy? That gets you, $250. That's kind of put your finger in the air and say, I could see that. It doesn't seem crazy to me. I mean, I could see them overshooting. I could see it getting a crazy multiple. These royalty stocks are like 40, 50 times earnings. I could see it just plodding along at, 5 times like it has been for the last couple of years. I can see anything happen, but this is how I'm playing gold. I bought a whole lot more stock in the last couple of weeks. And, this is really my favorite thing on my blotter right now. So anyway, that's A-Mark for you.
That's a great synopsis. You did a terrific job. Let's back up a little bit and just talk about gold itself a little, if we could.
Yeah.
One of the things is that it's definitely being led by central bank buying. And the story that you're telling, first of all, does A-Mark participate in the actual central bank in the institutional market, or is it purely a retail play?
No, it's everything. So they do wholesale too. If you want to go in there as a high net wealth guy and put in a $10 million order, like they'll get you better pricing. They have a high end bespoke channel. They just recently went into Hong Kong, buying the largest coin dealer in Hong Kong. So they own JM Bullion, which is the one that everyone knows. But if you live in Hong Kong, you probably know LPM. And for that matter, you might know like Gold Line and some of their other things. They also own 2 mints, a Sunshine Mint and also Silvertown Mint. So they have a really diversified, different verticals and different ways they can make money out of this. Well, I don't think central banks are buying from these guys, but I tend to think that, pension funds, endowments, we just learned the state of Utah has been instructed to go buy some physical gold and, store it themselves. Like, I think these sort of things, they could definitely be part of that mix.
Well, that was my next question is, do you think that the gold story has finally morphed out of the central banks are buying it, and that's why it's going up to the retail / institutions, like this kind of financial bid that we've seen in the past that has been lacking for the past 9 months? And I might argue it's Bitcoin kind of, took some of that luster away from gold, but it finally seems to be in the last week or two or maybe month that's been shifting. Do you think this is the start of a bigger trend?
Well, yeah. I mean, that's why I'm buying right now. I think it's
right.
It's definitely starting. But I would say, you could look at GLD and SLV. They publish daily the number of units outstanding. They've really been in downtrends since 2020, and You've seen no uptick. I mean, maybe 1 week we've seen a couple percent uptick. You have not seen an uptick. I think that shows you what, retail investors are doing, and that's telling you what hedge funds are doing. I mean, these sort of guys are going to buy their GLD and their SLV, and You haven't seen it like PHYS. That's at a small little uptick. You just haven't seen guys going in there. I think it's super interesting. Today, JM Bullion put up on their website, and we've been tracking these guys for over a year, all the different specials they do. And it says, due to increased sell to us orders, processing and seller payments could experience a delay. What they're basically telling you is that so many guys are taking some chips off the table now that the price went up, that they're actually having a difficulty processing it all. They've just been overwhelmed by sell orders, which tells you kind of where sentiment is in terms of retail and everyone else. I mean, everyone's selling their gold coins to buy more dog with hats. But, well, I mean, that's a store of value too, right? That and your NVIDIA. But I mean, in terms of JM Bullion, like if you're going to buy back metal from people at a discount to spot price, like great, they own the exchange. They buy and they sell. Like, I just want to see more transaction volume. But I think, in terms of where we are in the sentiment cycle, I think it tells you a lot.
So we're just super early. And the fact is that people are actually fading it as opposed to going with it.
Right. I mean, we were joking before you pressed play that I have this meme I keep putting up over and over, and it's Chairman Xi, and he's calling his broker saying, I have an order for a bazillion ounces. And, it's just like they have so much money they want to shove through a little keyhole. They can't figure out how to get it done, and they're moving the price. And, this reminds me of when I call up my sales trader every 13 minutes and I say, hey, have we gotten any done yet? And he goes, no, Kuppy, we've got 600 shares done today. And I say, just get more done. I need some more done. And it's just, that's what happens in small cap. But I mean, I'm a small guy going into small cap. Xi is the biggest whale in the world trying to go into a large market, and he's also muscling it.
Well, do you have any thoughts about why gold has been so hated even as it's risen?
I have no idea. I think there's just this PTSD. I mean, think about it. We had a decade from 2013 to 2023, and it was violently sideways. You had these $200 moves, and they just whipsawed guys. I mean, every time I post something on Twitter, X, whatever they call themselves this week, about gold, read all the comments. All the comments said, yeah, they're going to rug pull you, Kuppy. Jamie Dimon's about to queue up a down $100 single 15-minute bar. Kuppy, why aren't you buying NVIDIA instead? Or, I mean, Kuppy, you're a loser. Bitcoin's going up every day also. Like, I just think there's this weird sentiment change in gold, and people have totally missed it. I can't think of any time in my career where you've seen such a large, visible, liquid asset making new highs almost daily that has no follow through. I mean, everyone looks at the commitment of traders, and I get that. But even there, I mean, you haven't really seen a change in the specs versus the commercials, and you're really not seeing it in the GLD and the SLV. There's just no interest in the product. It's incredible. And I mean, until the wise guys show up, I think we're going to keep trending.
I completely agree. Like, I look at it and everyone's like, oh, it's US dollar is going to go up. You don't want to own it, or rates are going to go higher. And I go, well, it keeps going higher. You guys are just giving us the wall of worry to climb.
I mean, look at it today. Gold's up $35, and I mean, bonds are just getting splattered. I mean, if rates mattered, gold would be having a down day. I mean, look, FX. I mean, the Dixie's been range bound with like zero realized volatility for a year now. Like, it's not that. I think it's the fiscal solvency. I really do think that people are looking at the U.S. balance sheet, looking at our deficits, looking at the election coming up and saying, wow, one of these assholes is going to win this thing. And they're both spenders. And I mean, maybe it's not, guys in America looking at this and scared, because Americans seem blasé about everything. But I could totally see Xi and the other guys globally saying, what the hell's wrong with America? Why do I own all these treasuries? Get me out of it. And it's like I said, Xi's calling up his broker and saying, sell me $1 billion of treasuries, buy me $1 billion of gold, get it done by end of day. And he just makes the same order every day.
I've been saying this for a while. If you go look at China's FX reserves and you look at the percentage of gold that they have, it's tiny. It is a tiny, tiny position. And for them just to get where everybody else is means that they're going to be buying all the gold produced for many years. Like he just has to stay on the bid constantly. He has no real choice.
There is no more choice, though. I'm not sure if I totally believe their official number.
For sure. They for sure have more, but even if you just double it, they're still so far off. Their reserves are just so big, and the gold market is so small that I think that he, in his heart of hearts, he's been scared about buying it and causing a stampede because he doesn't own enough yet.
It could be that way. I think what's interesting, and you could track this spread on Bloomberg. I mean, there's been a consistent premium in China versus the US, and no one can explain it to me. It's not explained by tariffs or duties or taxes. And I mean, gold's pretty cheap to transport. There's nothing that explains it except for the Chinese are just willing to pay a premium. And I think the very different part is that, like Kev, you and I, when we trade gold, we trade futures or we might trade GLD, but I'm never taking delivery of the thing. I'm just going to roll my futures. The Chinese are actually taking delivery of it. And I think when you look at the intraday trading, I wake up at 7 in the morning and gold's making new highs. And I think that's them basically at the LME. And they're basically saying, yeah, we're taking delivery of this contract. And the guys in London are saying, what? No one ever takes delivery. What are you doing? And you've seen these like little mini short squeezes as they all scramble around for physical for the warehouse. And I think, we've seen that almost every day for the last 2 weeks now, around 7, 8 a.m. And, by the time the Americans wake up, it tends to tamper down a little. Maybe Jamie Dimon puts his finger on the scale a little. But I just think that the Chinese just have this forever bid and they're just going to, take it all.
All right. And so you're playing it by AMRK. Folks, go do your own research, as Kuppy said, but this is his alternative to the miners, his alternative to the royalty companies, and his alternative to buying futures with that huge carry.
Yeah, I just think this is the best way to play it. The guy who's running it, I mean, insiders own about a quarter of it. They've been active on buybacks. They give you dividends, sometimes some special dividends. I mean, I think the guys running it are, real adults who actually care about shareholders. And I just think this is the super high return on capital way to play gold.
Got it. Thanks a lot for coming on, Kuppy. We really appreciate it.
Hey, thanks for letting me your soapbox.
Take care, bud. All right, Patrick, it's time for Talking Charts. Lots going on for a change.
Yeah.
Actually, it is for a change. It's been kind of boring. It's finally getting a little more exciting.
It is exciting. I want to talk about it. Let's first go through our top three. So the top three things that we were watching last week was the US dollar. And while it's been moving, it didn't break out above 105. So it's still in that range, but it's still on a knife's edge on so many of these currencies. And it'll be really interesting to see if we finally get a US dollar that gets going, particularly if it's all the cross currencies that start moving against it.
It'll only do that once you stop putting it in the top three.
I think so. All right, number two, we were watching the jobs numbers that came out this morning, and while it was a beat, it's always interesting how they MacGyver these numbers. It's a huge amount of jobs coming in from the part-time side, and it's I don't know. What did you make of it?
Well, one thing I would say is that even if I gave like 90% of people the number ahead of time, I don't think they could make money with it. Like, just because you had the number, you still wouldn't know what to do with it. And if you looked at the market, it was kind of confused at first. It went up, down, and then it eventually started to rally. But it is, I don't know, Patrick.
Yeah.
I think that
let's stop talking about
numbers matter too much.
All right.
I don't think they matter.
So
inflation is what matters.
Number one, we put does the Mag 7 advance continue, and more or less it did. I mean, yeah, okay. Apple isn't participating, and Nvidia for once is actually stalled out a little bit. But Microsoft is plugging along. Google has had an epic go in the last 2 weeks, and so there's a number of these Mag 7s that actually made a pretty good push. It'll be interesting to see whether or not Nvidia joins the party if this upside breakout's going to happen.
All right, so what do you got for this week?
All right, earnings season coming up. Obviously, the pig in the python moment is going to be actually still 3 weeks away, but we get the earnings season kickoff, including many of the bank earnings and things like that are going to start coming in. Be very interesting to see whether or not these companies can keep beating expectations like this.
All right. What's number 2?
You have no comment. Hey, all right, number 2.
No
well,
comment.
next week we just have a slew of the central banks coming out. Obviously, the Bank of Canada. We have the ECB, and then the FOMC minutes will be released. And so I think a lot of the eyes will be on the European Union and see what's going on there.
All right.
And number 1 is inflation. We have the inflation numbers next week. So certainly a very large amount of economic data points coming out in the early part of the week or the mid part of the week. So it'll be interesting to see whether the market volatility picks up from all of that.
Okay, so what charts are you looking at?
Wow, you have really nothing to say, do you?
I have nothing to say. Well, you didn't ask me about the one that I had something to say about central banks. I was going to say the Bank of Canada is on deck, and that guy could be the world's worst central banker since Jean-Claude Trichet raised rates in 2011, right before the European crisis. Clueless, sell Canada. Our rates are way too high for our economy. We're about to really shit the bed.
There you go. And so let's talk about these markets. What was interesting yesterday was we had a pretty significant breakdown day. I mean, I would say significant only relative to the type of downside volatility we experienced all year, which has been almost nothing. And so it was one of the bigger down days of the year. But it came with a spike in vol. And so we had the VIX jumping up to the 16 level, 16 handle, and 1 day volatility got all the way up to the 21, 22 levels. So there was definitely some grabbing at some portfolio insurance as the volatility picked up. But what was interesting, obviously, is after his jobs numbers, the market rips back completely, almost undoing the entire down day. And yet volatility has not come off the highs.
I know. I'm kind of concerned about that and worried.
Concerned and worried all at once. Concerned and worried.
They're the same thing, but
it is a little bit interesting that the market's rallying and the volatility actually never came off. It's not what I would have expected. Certainly, it's certainly not the typical reaction that you would see when a market gets bought like this. But I think we're going to get a really big tell, because this primary uptrend that's been in place, this upwards channel with using these nice thick crayon lines, was violated for the first time, and that
is that pardon.
It was violated, and so the interesting part of that is that in itself isn't necessarily bearish. It's when a trend line gets steep enough, it's inevitable that any type of a correction would violate the trend line. But the interesting part will be whether or not the bulls actually show up and follow through on the buy on dip. I think the more interesting thing going into next week, which again, the inflation numbers and the FOMC minutes and all of this stuff is coming out Tuesday, Wednesday, Thursday. And so we have a scenario where if the markets cannot beat 5,300 back on the upside and they roll over, then this starts to be and have the characteristics of a topping formation. And that could be what starts spooking investors. It's really, really important that if this thing is going to stay bullish, that the bulls bust through 53 and retake ownership of the trend, and everyone then can calm down and will just be more of the same of what we've seen all year. The jury's still out. I obviously think the stock market is way overdone and long overdue for just a pause and a correction. I don't even want to, say we're going down to 4,000 or something. It's more about the fact that after a 1,200 point run, there's going to be a point where there's going to be even a 50% retracement, a typical 10% market correction. And they happen usually once a year. We're overdue for one.
So I was looking at that chart, and you had, ever since December, every single big red bar has been basically had a rally since then, right?
Yeah.
Like look at the one in December, Same thing happened. Then we had one in February. Same thing happened. Another one in March. Same thing happened. And I was actually thinking to myself, okay, what's different this time? And I'm surprised that we were both thinking the same thing in terms of the VIX, because that's ultimately what I thought to myself is what's different is that before, when you got that sell-off, and then the rally, you got an immediate selling of vol. And yet this time we don't have it.
Well, you know what saved the market, I think, back in February and March was sector rotation. So when, even though the Mag 7 stocks haven't really sold off, they really stopped rallying with momentum. And that means the money flow just wasn't flowing there remotely to the same degree it was for the prior 4 months. And that was clearly that sector rotation, and the primary benefactor, hands down, had to be the energy market. Like the run that we saw, let's say in the XLE or the XOP, all the Exxons of the world, these energy stocks just had an epic go on the upside. And this time, though, we have a scenario where there is no real beaten down sectors. I guess you can argue that healthcare, there's a number of beaten down names that have not participated. But outside of like healthcare, there really isn't too many places that are cheap that could take rotation. And so with so many overbought sectors, that I think makes the market that much more vulnerable because what's the next part of what's going to drive the next advance if it was going to be bullish?
Yeah, I don't disagree with you, Patrick, because back then I kept arguing. I said we could get a rotation that keeps the bull alive, and I said that at numerous times. And now I'm like, everything I look at is overextended and just up on a stick, and I'm like, oh, geez, tough to find something to really be constructive about that's not already rallied a huge amount.
Yeah.
So I'm worried. I'm worried with you. Concerned and worried, Patrick.
All at once. That's unbelievable. All right. So what also continues to be interesting was the NASDAQ divergence. So like while the Mag 7s never really started to sell off, they have lacked participation. But that sector rotation is so evident. First of all, we haven't seen the NASDAQ, be able to beat highs for, I would argue, well over a month, but it could be even longer because even though it poked higher a number of times, it gave it all back each time. And the interesting part is just how nasty the breadth of the market. So if there was one spot where the market has not participated, it has to be in the 4-letter stocks. And you can see here the breadth of the market on the NASDAQ specifically is like 42%. That means more than 50% of stocks are in a downtrend on the NASDAQ. And that, when you compare, let's say, to the S&P 500, S&P 500 was right back to 85% just a week ago. And so you saw that's where the energy stocks, that's where all of these things widened the breadth of the market, and the S&P 500 ripped, but the NASDAQ didn't budge on its breadth. And so if there was one area that could continue the rally, would be suddenly if NASDAQ got love again.
And I was just thinking about it. What about XBI and IBB?
Yeah,
maybe it's the biotechs. What do you think? Pull up those charts. Give me your Crayola.
Well, you know what? Everybody was so bullish the biotechs a month ago. And I've loved biotechs. It's actually always one of my favorite sectors to trade. And I was getting nervous by just how many people loved it. It seemed like it was a crowded theme of everyone trying to call the upside on it. And nonetheless, it's a very heavy chart. Like in a sense that the biotechs have basically stopped running on the upside, and some sort of distribution cycle has definitely started here. And like when you look at the XBI, it had a stunning breakout that should have gone to 110 by the basis of technical measured moves, and it gave the entire previous rally back, which is usually the first sign of a potential topping formation. All it needs is one failed rally, and this could be where a head and shoulders or some other type of a topping formation starts to form. I'm not bearish them, but they certainly aren't being bold.
Okay.
Like I would generally position myself more underweight this space, and I think that's the safest way to go. Now, I know Kuppy was talking gold, so I want to actually first let's talk currency for a moment. So the dollar corrected off to 105, but I don't think anything has changed in my bigger view that the currency markets are the thing to watch. And until when I stop mentioning it, it was when the move will happen, like you were saying. But it's still the case where the U.S. dollar yen is right up along those highs, and I hear your argument, like you and a number of the guests that come on I always highlight how cheap the currency is, and I in principle get it, and I think you're like bonds, your bond thesis, you're going to be right at some point, but this still technically looks like it's going higher, and I think that it's going to be a huge intermarket event if this 152 level is broken on the upside of the US dollar yen, because I think that it could trigger a short squeeze of all of the Kevin Muirs of the world that are on the wrong side of this trade, and like this could shoot to 155, 156, and that could have ripple effects on flows right across the entire intermarket space. It is the thing to watch. Has it broken out? No, but it's like right at the edge of the cliff. Like this is
it's gonna do a prairie dog if it does that, Patrick.
Of course, so you can have that fantasy. That's why you're going to hold your short like a diamond hands. Diamond hands. You're stubborn diamond
Samurai
hands.
hands.
But what will be interesting is the euro obviously bounced a little bit off of testing that 107 level, but we're going into that ECB meeting, and if this gives out 107, like all these lows from February and March, it's not stopping till the September October low, and that I think could stir the markets up. I think that's truly a risk off event when the dollar starts to rally, and that could contribute to the stock market rolling over.
What does gold do in that scenario, Patrick?
Well, this is the crazy part, right? Like all of the correlations are out the window. All of the things like correlation to real rates and inverse to the dollar, none of it. It's all out the window. Gold has just got doing whatever the hell it wants to do, and it doesn't give a shit about all of the things that have driven it in the past. And to me, this short-term move is already done. And it's usually going to pause, but it could be a pause that's nothing more than just like a 5-day little throwback that ends up being a buy on dip. I think that at this stage, after this move finished, if this thing was to give you a gift of a dip down to 2,200, you pull out the wheelbarrow and buy that dip with anything and everything you've got. I think a little on the short term, it's a little overdone, but the bull trend is underway. And, I still think there's room for this to have some surprise volatility during a risk-off cycle, just because people sell. This thing always correlates when there are some sort of liquidity events. But overall, this is a very significant bull breakout. Like this is the monthly chart on gold. Like this thing has broken out. There's all sorts of measurements to 2,700 from a technical perspective. And it looks and feels very much like the rallies that we saw between 2000 to 2011. Generally, I don't see why one should fade that kind of a view when something is so strong. And the part that, Kev, I think that we agree on is no one loves it yet.
Yeah.
Like something
And in
that
fact, everyone I know that owns it is scared shitless and selling it, or just scared. Like nobody is saying, "Oh, I got to buy more."
Yeah, and that in itself, like it would be the opposite if everyone, if it was front page news on newspapers and everyone was excited. If I was getting phone calls from my grandmother and cousin that don't know anything about markets and should I buy gold, when you start getting that kind of retail interest and participation, that always gets me nervous. There's none of that. Nobody is calling me, asking
Nobody.
me. Nobody.
But I will say we both have the confidence to talk about it publicly on the show, so we're probably screwed.
And we both agree. And we're both long, so everyone knows that
what to do.
Yeah. By the way, I'm not buying up here. I buy dips and not rips, and so I have a good positioning. I actually collared up a lot of gold. The beautiful thing about the gold market is that skew. Those calls pay such rich premiums that you can create these super asymmetrically skewed collars and still have either a credit or even a very small debit. Yet
Patrick, you're giving away the right tail, buddy.
Dude, what for 3 weeks? You don't. Yeah, I get it. If you collared it for the next 6 months, I would say that's an awful mistake. But the thing is, if you're an active trader and you're trading the swings and you hedge out for 2-3 weeks, to me, it's a no-brainer.
All right.
Yeah, listen. Yeah, one day we're gonna wake up and it's gonna just open at 3,000, up 1,000 one day. I've heard the story from you a million times.
Oh, no, it's a week. It's gonna take a week.
Exactly. So I'll have plenty of time to roll it up. It's let's touch on oil here. My first target was around $85, and that was the Fibonacci zone. This thing blew through the fibs. Obviously, there's now increased chances that there's geopolitical risk premium in the Middle East that has to start being baked in, but this thing is getting a little. Oil's not crowded, but the oil energy stocks feel like everyone is a little too excited, but. To me, oil going back to the September highs of last year in the mid 90s seems the only logical target at this point. Now that we've kind of this is no longer retracement, so at this moment, approaching previous highs is the only logical target on the upside. But the bigger question I have for you, Kev, do you think the backdrop is there for us to see 100 plus?
Oh, for sure.
So it's interesting because, on that show I Cheat on You with, when a guy like Anas comes on, talks about surplus and capacity and things like this, it gives the impression that oil will stay kind of within a range for a longer period of time. And so, what are in your mind the drivers that override that? Obviously geopolitics has to be the number one.
Well, I think also China. I think most of the world is too bearish China in terms of their economy. So that would be my thing. I think it's a demand situation. Demand surprises to the upside.
Okay. I could that would be an interesting idea, but do you think but that's kind of a 6-month story. Do you think that there's what's the immediate?
I think that over the short run, it's extremely difficult to say what is truly driving it. So I know you guys all look at the inventories, and I on that show that you cheat on me with. I remember your partner there talking about, I don't understand why oil is going up. The inventories are so large. And I'm like, when you hear that over and over and over again, you start to think, well, maybe the inventories aren't what you think, or they're not driving the price.
Yeah.
And ultimately, that's how I feel about oil. That a lot of the things that when you go and listen to these people, they'll say, oh, the inventories are such, so therefore oil has to go down. And then you go look at the data and it doesn't actually correspond. Like for me, I actually like Warren Pye's from 314 research, where he looks at sentiment on the COT and the commitment of traders, and he uses those signals. And I'm more worried about that. And I do believe he's recently gone to a sell after nailing the bottom. And he's actually, his model is flipped. And so if I was to pick a reason why we might go down, it's because even though it might not seem it in terms of when you talk to people, when you look at the COT, there's a lot of new longs out there.
Absolutely. You know what? My primary, thought exercise is always, where's the pain trade? Where's everyone on the wrong side of a trade? And where can the market cause the most pain? And you have to assume that could be the base case. That's where you start building your hypothesis around. And this is the whole thing, is like making money in the last 5 months has been easy. And
speak for yourself, buddy.
No. Like literally anyone who's been long, like other than being long bonds, you pretty much, it's pretty hard not to have owned something that hasn't made a lot of money in 5 months.
Yeah, no, you're right. I wonder why those bonds go down. They're such a great asset.
They are.
Don't people realize?
They're so great. Yeah, it's a great diversifier, buddy. 60-40.
To diversify your gains.
All right. It's interesting how gasoline continues to plug along. I mean, that must be making the current administration a little bit nervous, but it certainly does ask the question as to whether the inflation number is going to come in hot.
Oh, Patrick, I'm all over this with you. Like, the 1-year inflation swaps have exploded. If we go look at them, let me just pull it up. I think at Christmas time, the 1-year forward inflation swap for the next year, so from like January to 2025, it was, let me just have a look. Sorry, I'm not good with my Bloomberg codes here. It's currently trading at 266. And back in January, it was 2 on the nose.
Yeah.
So think about that. That's a huge change in market expectations about inflation over the following year.
It's yep.
And listen, a lot of it is gasoline.
Yep. It's you know what, global refining is being stressed by geopolitical stuff and wars. And there's a lot of things that could keep this market elevated. And in order for there to be a disinflationary impulse, you need commodities to be kind of range bound and dragging. And when you look at things like the foods, like let's just take a moment, like look at the grains, like wheat. I want to put on a weekly chart and just like recognize that the bear markets in things like food have already played out. Like, I seriously doubt wheat goes, from 566 down to 300, but yet it already went from 1320 down to 500. So like the damage, or corn or soybean, these things have been contributors to a disinflationary kind of, inflation at least coming off. But the thing is that they're not going to contribute further to disinflationary pressures. And in fact, if they turn, they're going to massively contribute to an inflationary impulse.
So I have 2 things to say. One, I have this buddy that's one of the smartest, greatest traders out there.
Other than me?
He's better than you.
Oh my God.
I like to call him the oil whisperer, and he's just a terrific guy, and he's just a quiet guy that just keeps to himself, but he'll say, "Oh, I'm going to do this." And I'm always like, "Geez, that works." He was the guy who was selling oil puts the whole way. And then eventually, he's gone and gotten himself long the grains. And he never talks about the grains. I was like, "What? Like, you're buying grains?" And like, yeah, he's been picking away at the grains. I think he's probably onto something there. And then the second thing I wanted to say, Patrick, about oil and gasoline is that if you look at all of the economic expansions and by such stock market rallies, they usually end with a spike higher in oil.
Yeah.
People forget that, and people think, oh, .com, oh, it didn't happen then. 2007 and 8, it was the financial crisis. Go back and look. Each one of those, oil spiked right before it. It's often the element that causes the Fed having to be tight, which then therefore slows the economy.
If oil clears its September highs and is like heading toward 100, how does the market not freak out?
Right. But you were asking me, do I think it could go up there? And I said, yeah, it could. And I think that is probably the last stage of the bull market. And when that happens, you need to be watching for it.
Yeah.
But often oil's rallying are the last stage of the bull market. That's all I'm saying.
But rarely do things play out exactly the same as previous playbooks. But you're absolutely right that would be a huge catalyst if you were right. I want to talk about silver. It's amazing how silver was the forgotten commodity, and suddenly it upticks, and everyone. Suddenly, all these silver bulls come out to kind of make their bold targets on the upside. Obviously, I've always loved the precious metals, and so. But the interesting thing to me, I find it. I think that silver is going to bump its head at minimum up along all these previous highs, and so I think that at this stage, both gold and silver have probably on the very short term kind of overextended this move. But I still think old dips have to be bought. So if like silver comes back in $2 and hits $25.50, you got to buy it. Like,
there's a true technician.
Buy dips. No. And that's not a technician. No. Like that's the only way to build. That's the only way to build asymmetric trades. Buying rips never works in terms of asymmetry. It only works for riding momentum.
So I think this is a great discussion to have, because I've been thinking about gold and I've been tempted to sell it the whole way up. Like every single time, I'm like, oh, geez, it's gone too far.
And you certainly won't collar it.
I won't color it. I got to figure out what that even means. Anyways, and then I kind of think back to the things that I tried to fade, meaning like moves that I thought were excessive in the past in other stuff, whether it be bonds, whether it be, EVs or whatever. And I think it's one of the kind of features of the current market is that the amount of people chasing momentum means that it's going to go farther
rolling
than
bubbles.
most people expect.
Your rolling bubble thesis.
Yeah. And I think and so whereas I kind of I've given up trying to go, oh, it's gone too far too fast. Like I feel like that's like the most expensive words in the trading language these days.
Well, you know what? This is why I love the option overlay, because when I feel that, I don't sell my position. I just hedge it. Yeah, and so that way you don't lose your core position. The people that don't use that strategy then start selling, and then they suffer regret, right? Like,
where can they learn more about that strategy, Patrick?
Oh, I'm not gonna. Everyone knows where they can find me. I'm not gonna do a plug. All right, I have a new book.
You should write a book.
Oh my God. Copper looks like it's going to 430 here.
Oh God. Does it have a PhD? Is that why? Did it finally graduate with its PhD?
It did.
Its dissertation?
And you know what?
Or whatever.
But you know what? I feel that the PhD is going to fail it here. I'm a seller on this being an indicator that the economy is well. It's a squeeze, and I'm totally into fading copper. I wouldn't fade gold, but I'm going to fade copper.
I feel like I should go buy. I should move some of my gold into copper right now.
There you go. There you go. Well, but listen, to make it clear, I have zero shorts right now, and I do think it actually still goes higher on the short term, back to those highs. But I'm going to fade it. You can count on that. The other thing I wanted to just touch on is uranium. And the interesting thing is that, so we had a little bit of a bounce in the Sprott physical. And interestingly, the bounce came, but it was almost no participation in actual spot prices. Like literally, we saw this is the discount of the net asset value to the spot, and we saw the discount almost close.
Right. So you're saying the rally wasn't led by spot; it was actually led by the discount closing.
Yeah, and so to me, this is where I'm torn, because to me, this is vulnerable for actually another dip. But yet uranium stocks have decided to break out like they're ready to go. And the thing is that what are the uranium stocks? Is it one of those scenarios where the uranium stocks are kind of leading the way, and they're kind of and is it possible?
Well, I would say, first of all, different people can own U.UN versus uranium stocks.
Okay.
Like not everyone can go buy U.UN. A lot of fund managers, they're not supposed to buy commodities. They're supposed to buy companies.
Fair enough.
Right.
But the point is that a lot of times, like even in the energy space, you'll see, let's say, or in the gold space, you'll see that there'll be lots of times where the underlying stocks will start moving before the commodity does, and they sort of lead it, and the commodity follows, like these.
Yeah, fair enough. I completely agree.
So the question is that, in my mind, and I don't know the answer to it. It's like here I'm looking at uranium and the discount closed, and the uranium spot price not really moving, and yet uranium stocks are being accumulated and buying and breaking out. And I'm just wondering whether or not that's signaling something. I don't know the answer to it.
I think the uranium stocks could go higher even with U.UN not going anywhere.
Okay.
I don't think that they necessarily have to be as correlated, or, as the relationship doesn't need to be as tight as you think it can, as it should be.
Right.
And I suspect that what's happening here is that the big guys have finally gotten a hold of the trade, and Fidelity is not going to buy, U.UN. At least I don't think so. Let's have a look here. But they're going to buy Cameco. So let's just go look at like the Cameco holders and see who's been buying it here. So yeah, Fidelity has 31 million, and it's the new position for them.
Yeah.
Right. And so now let's go look at U.UN and see if they own that. I don't think they will. Yeah. See, nowhere to be found. It's a bunch of wise guys that own the U.UN.
Yeah.
Right. It's all hedge fund / family offices and stuff. It's not the same. It's not the same audience.
Yeah. But okay, so I wanted to just touch on one thing, because we talked about the grains, and you're absolutely right that the grains have started to turn. But what's interesting is that the ag stocks have quietly started to bottom. Now, the ag stocks have been in an awful multi-year bear market. Right? Like they've basically started selling since the start of 2022. It's been a 2-year route where in many of these stocks are down almost 50%. And the pattern of lower highs, lower lows, and a clear downtrend has been dominant. But really, the last 6 months, they've stopped selling. And it doesn't mean that they've started a rally, but the sellers are no longer, the dominant momentum flow. And the question is that are the ag stocks bottoming here? And
what do you think?
I think so, but the question is there a catalyst? The thing is that during these kind of bottoming formations, it could stay dead for months and months. And so I think that anyone who's buying here can lean on the fact that they're cheap and that they've stopped going down. So you're buying a value asset type of thing. But it could also be like a value trap where they just stay down here for a while and nothing happens. I'm curious whether or not some catalyst emerges that suddenly, has all the grains wake up and suddenly this becomes a loved sector again.
So what is this? What's this ETF you're showing us?
Moo? Yeah, it's the ag business ETF.
It's our buddies Van Eck.
Yeah.
Nice.
But let's just say we use the NTR, like the nutrient, right? I mean, this thing was murdered for the last.
It's
2
the
years.
same chart. Yeah.
But you can see that it really in the last 6 months has more or less stopped breaking down, and even if it did break down, it quickly recovers, and it seems like at least that the selling has subsided. And you know, if you draw your thick crayon lines, you know, these things have suddenly started to turn a little bit. I'm not opposed to the idea of them bottoming. I just don't know how much love they're going to get or whether it's too early. But certainly I'm paying attention. And the final thing I want to touch on is your Nikkei play. And that could have been a prairie dog.
No, the prairie dog that's
yeah, you like your extended
need,
basing, but to me,
yeah,
but to me, what I mean by that is that for this entire bull run, when a breakout to new highs like this happens, it usually is an advertisement that it's a green light, all go ahead, and this thing should have been at 43,000 on the upside in the follow through, and instead it gaps higher. And it's been selling since. And that, whether you want to argue with me, doesn't define your vision of what a prairie dog is. To me, that's a fake out breakout. And the fact that the sell-off has wiped out the entire rally, last leg of the rally that happened in March, is at least signaling that it's heavy. And it's lost that bull momentum. Now, it doesn't make me bearish. I'm not short the Nikkei, but all stocks and all markets inevitably correct. And this is the kind of price action that is kind of suggesting to me that this leg of the bull impulse is probably paused. And we're going to see this thing backfill a little bit. And it's interesting because the Euro stock as well had the bearish engulfing candle come in at the high there. And this is the interesting part of, we're now seeing all the developed markets starting to show kind of turns. And that to me, and with the fact that the VIX is still high while the market rallied today, I think the market's still vulnerable.
Yeah. I don't disagree. I'm looking at this Euro stocks. That's not a good looking chart. Like that's not good. And I can't push back on the Nikkei. It's due for a pause.
It's a pause.
Right.
Like I'm not bearish. I'm not going to short it. It's just every rally is met with a corrective phase, whether it's a sideways consolidation or some 50% retracement. The all rallies inevitably pause, and it's feeling like all of these things are pausing here. All right, so Kev, is there another chart I should talk about, or are we going to move on to your crayons?
Crayons with Kev? No, let's do it.
Okay, so crayons with Kev, what chart do you want to pull up?
So you got to pull up EWW for me.
Okay. 1 second here.
Which, for those who don't know, EWW is the iShares
Mexico. Yeah.
Look at this thing. No such thing as triple tops. Thing broke out. It's headed to the moon, baby.
Headed to the moon, or is this going to be a prairie dog?
So this potential has the potential to be a prairie dog. I don't think so. I actually really as well like it. Can you show this chart? Look at that. It's beautiful. It's beautiful, I tell you. Can you show this chart relative to the S&P?
Yeah, we could put it over the S&P, sure.
I like that too. That's
just do against it.
This is like
this is the EWW over the SPY.
Yeah, I feel like it made a higher low.
Yeah,
now I'll figure out this technical mumbo jumbo eventually. It feels like it made a higher low.
I am a very big fan of your Mexico thesis. And even your China stocks. Like sorry, not China. So your Japan. I don't like the China story. But
you don't like the China story?
No, I don't like the China.
Not
as an investment. I mean, I get the
fact. Why?
Because
you're scared about Taiwan and us getting zeroed.
I just don't think it's worth the risk.
So did you think it wasn't worth the risk to buy Russian stocks?
I didn't.
Okay, I just laugh because a lot of the people that seem to think that it's not worth the risk for the ones that own the Russian stocks. I really don't think it's going to happen.
Look, I'm just saying it's not worth the risk.
1 second. Everyone's gone from saying it'll never happen, there's no way you'll ever get zeroed, to every single, conflict out there is going to cause a zeroing of your equity.
I don't think it's about zeroing. I think it's, you highlighted in one of your pieces that interview with Russell Napier. And one thing that I thought was particularly interesting was, a lot of people, look at things through an economic lens or a financial lens versus looking at it through like a historian as a historical lens. And the fact is that China is in a position, and when you look at history of what happens when you are the second largest competing economy, I'm a seller on the idea that the Chinese are there to enrich Western investors. They don't give a shit about enriching any Western investors. I think inevitably something is going to make that a reality, whether it is Taiwan or not Taiwan. I just don't think it's worth the risk messing around investing in China.
Okay. I think
anyway, but
way underowned.
Okay, back to this chart though. Let's talk about Mexico.
Okay,
and I love the story, just like I like a Japan story. I just find it very challenging to be long any equity market when I think that the global developed markets are so overextended. I just think
so I do too. I don't disagree with you. But if I had to add risk and I had to sell, I'd love to sell. That's why I showed you S&P versus the EWW, because to me, I think you sell your US and you buy the Mexican.
So this is an ascending triangle pattern, and essentially you could use you look at the length of these two rallies. So this was a 50% $22 advance, and this last rally over here was a $17 advance. So expecting that this next leg of this rally could be a move to $80 on the upside. It's certainly the way that a technician would observe it. It's above all its moving averages, making new highs, broke it to a thing, spent several months consolidating. It is a bullish chart.
Yeah, don't overthink it, baby.
Okay. Anyway. All right. That was Crayons with Kevin. You nailed one. All right.
Thanks, buddy.
All right. So let's give it a wrap.
All right. So thanks for tuning in to us. Sorry, let's try that again. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter. Daniel gets bored of talking to Patrick and I all the time. You can listen to Market Huddle on all the networks. You know the stuff. Patrick, where can they find you, buddy?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Sarezna. Kevin, where can they find you, buddy?
I'm at themacrotourist.com, and you can come to our chat. Everyone's welcome. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show. Okay.
Right. Danny, hop on.
Hello.
Yeah. Did you finish the beer, Patrick?
Absolutely not. This may have been the worst beer I've ever tried in my entire life.
Now,
literally, I'm only 1/3 through this can, and I'm literally reluctantly sipping at it. I will never drink this beer again.
Is it because it's too strong, or?
No, you know what? Actually, it's not like I feel the alcohol. I'm not finding it enjoyable at all. And that's
so give us a number. What is the worst beer you've ever had?
3.1.
Oh,
3.1.
Yeah.
So even the worst beer he's ever had is still a 3.
Because
alcohol.
I gotta always leave room for there to be a worse beer.
Yeah, that's true.
I can't go and I need
I
to have.
I feel like though this should have been a sub 1. I really do, Patrick. I feel like you goofed on that.
No, but listen, this is awful. This is. You know what? I've had a lot of amazing British beers here, Danny, but this is not one. This is not one.
Fair enough.
So listen, you can't put milk in beer.
Like I was in like London last weekend, and I went out of my way to have a nice glass of Guinness, and that was so delicious.
Yeah.
Oh,
But that's not really a London beer.
no, but I was
beer, Daniel?
it's not a London beer. I get it, but you know what? When in that part of the world,
I get it. I understand what you're saying. Daniel, what is the working class London beer?
Oh, don't ask me that.
Come on. Oh yeah, because you're so fancy. You're so posh you wouldn't know.
Exactly. Yeah.
Yeah, you.
I don't know. Foster's.
Isn't that Australian?
Yeah, but it's pretty sure it's brewed in London. I don't. Do you know what? That's a good question. I don't actually know.
Okay, people, let us know what the working class
Carling.
London beer.
Carling. That's British.
Oh, really?
Yeah.
We had a Carling O'Keefe. I wonder if it's the same Carling.
It's disgusting, or whatever it is. It's absolutely disgusting.
and it's like a pound of beer kind of pricing, and you could buy it.
But the thing is, though, like the beer in Europe's way cheaper anyway. I mean, even,
yes.
Like, you didn't let me rate this beer, but.
Oh, sorry, no.
Sorry. Okay,
Danny.
Go ahead.
Guys, come on. I'm actually going to give this a solid 2.5 because it's absolutely horrific. But it's still alcohol, so I'm still happy.
Now that sounded very British.
Yeah.
See, now there's a 2.5, and it's not even the worst beer he's had in his life.
No, I've had worse, 100%.
Yeah, see.
But listen, I honestly have you ever seen me give a score under 5?
No.
Never.
But I've never seen
this
you
is
say it's the worst
literally
beer you've ever had.
Okay, you know what? I have a short-term memory though, so it's
From having too many beers.
Yeah.
All right. Okay, so folks, let us know what the London kind of working class beer is. We want to know. And what are you guys up to? Where are you, Patrick? And where are you, Daniel?
I'm in Lisbon, but boarding a flight this weekend to Mexico. That's where I'm gonna be there for a month, and gonna have my big 50th birthday party down there, buddy.
Oh wow! So are you flying on the PJ?
The PJ? What is that?
Private jet.
Oh yeah.
You're giving away
I don't
that
even
you
know.
don't fly
I
on
don't
a
fly private jets. No, I do not.
Daniel got it. He obviously flies on the PJs.
Oh, yeah. All the time.
Yeah.
Oh, no.
Where are you, Daniel?
I'm in the Spanish Pyrenees currently.
Ah. Is that where the dog's from? The Great Pyrenees?
Oh, yeah,
Must
maybe,
be, right?
Yeah. Because you got the French and you got the Spanish Pyrenees. But I'm driving back from Lisbon to the UK. So not on the PJ, but in the...
Oh, it is a very private van.
Oh, God, you're making it sound weird now.
All right, I got to call.
By the way,
I got to let you guys go.
But before I let you go, was it true that you guys had a huge snowstorm in Toronto?
Yeah, it snowed yesterday. Well, I wouldn't say huge, but it was weird that it snowed.
It's like it was like 20 degrees. You had a 20-degree day in like February, and then like goes to like snowing in April.
Yeah,
unbelievable.
I was telling my buddy Rupert Mitchell, the blind squirrel. I was saying to him, he's British, and I said you picked the right colony to go and live in because he lives in Australia. I was like, it's snowing here.
Much better.
All right,
much better. Okay,
all right,
guys,
let's wrap it. Okay,
take care, everybody.
Take care.
Bye bye.